Welcome to the European Market Open. A minute's go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. US headline and core CPI readings will be poured over for clues on the course of Fed interest rates. Equity and Treasury moves are muted before the report. Hike versus hold. Fed officials signal divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are now planning to bolster their capital reserves. Let's check in on these markets then. Yes, you are looking, of course, at many investors hoping to stay on the sidelines ahead of that CPI print and the dispute amongst those Fed officials really spotlighting the lack of certainty and conviction around the direction when it comes to the inflation and that print later out this afternoon in the US, of course. Let's check in on the open as Goldman Sachs suggests that if you get a print of 6% or at least above 6%, and that was the number that we got in the previous month when it comes to the headline inflation year on year, if you get a number above that, you could see downside of at least 2% for the S&P. So we watch the market moves, of course, ahead of that CPI print. The FTSE 100, not a lot of movement in the first few seconds. We'll go cross-asset in a minute, but of course you have to reflect on the fact that across the European equity space yesterday, you posted some modest gains, modest losses when it comes to the US, so a bit of a split picture there versus US versus European equities to end the session on Tuesday. Currently, the Spanish IBEX gaining 0.2%. Over in France, gains of just 6 points. And here in the UK, the FTSE 100 up 0.1%. Let's switch it over and see how things are playing out cross-asset. Just worth flagging what is happening when it comes to those Chinese tech stocks listed in Hong Kong. A bit of a hit there, given what is happening with Tencent and concerns, at least from some investors there, that Prosus, the biggest shareholder in that tech company, is going to be potentially selling down more of its shares. Futures in the US pointing range bounds, euro-dollar 109. That is a gain of 0.2%. And the 2-year holding above that 4% level. It is, of course, all about the CPI print out later today. The countdown is on, and of course, what it means in terms of guiding us on the Fed decision-making going forward. Goldman Sachs sees, as I mentioned, stocks dropping at least 2% if the year-on-year rate comes in above the previous reading of 6%. Let's get to our markets reporter then, Valerie Teitel, who's been pouring through the details and getting a preview. What are we expecting, Valerie? Where is your focus going to be?
Well, the headline number is expected to moderate quite substantially, Tom, from 6% previously to 5.1% today. That is the Bloomberg consensus estimate. But a lot of the attention will be on the month-on-month core number that is also expected to moderate, but not by much. From 0.5% last month to 0.4% today. A lot of the attention is even going to be on the breakdown of this core number in between core goods, core services, and core services ex housing. We know that core goods has really been dropping like a stone in the last 12 months, but the more sticky component of core services has continued to creep higher. It's good to remember that services inflation makes up a majority of the core services, core inflation print, and has been responsible for a lot of the CPI expansion in the last few months. Additionally, services inflation is less sensitive to interest rates. Has the Fed tightened enough in order to moderate it? You can see that in that chart here. The super core inflation metric, which Powell has spoken about, that's there in yellow, has really failed to moderate substantially in the last few months. And then we also get the Fed minutes tonight. Don't forget that, Tom. Will they see a discussion on perhaps weighting the economic data, weighting the CPI data against the softer lending surveys that we've gotten recently? We've gotten 2 lending surveys in the last 2 days that have shown that credit availability to both consumers and small businesses has tightened in the month of March. Will the minutes show any discussion on which one will be weighted more for the May meeting?
Okay, so the minutes in focus as well. And Valerie, what have you been making of? What is your assessment of the commentary we've been hearing from some of these Fed officials?
Look, Goolsby's comments really stood out to me, Tom. He very much suggests that he's in the camp for a pause in May. He urged prudence and patience when it comes to interest rates, saying that they need to be patient in assessing just how much last month's banking turmoil will contribute to those tighter lending standards. That stands at odds from New York Fed President John Williams' comments earlier this week. He even said that we haven't even seen any clear signs of credit tightening yet. And Williams urged that, you know, more needs to be done. One more hike this year is a reasonable starting place, he said. Also heard from Fed's Harker yesterday saying that they have to take more action on inflation. So definitely there is a discussion now at the Fed whether a pause in May should be considered as we wait to see where these lending conditions, if they tighten enough to weigh on inflation.
Okay, Bloomberg's markets reporter Valerie Teitel with a look ahead, of course, in terms of the breakdown for that CPI print and, of course, the commentary you've been getting through from some of these Fed officials. Let's bring in Wei Li now, BlackRock Global Chief Investment Strategist. Wei, great to have you in the studio, as ever. Let me start with this then. The Bloomberg write-up of your latest strategy note, BlackRock and the team led by Wei Li ever more convinced that inflation will remain sticky. What underpins that view?
Well, as we entered 2023, we rolled out a new playbook that requires us to be more dynamic when it comes to asset allocation. So after the SVB fallout, we actually saw a break-even 10-year, for example, in the U.S. falling significantly to just above 2%. That is way lower than our expectation for where U.S. inflation would eventually settle around, which is around 3%. So we spotted that tactical disconnect and window, and we added to our overweight in U.S. inflation-linked bonds. So that's really more of a valuation point around our conviction behind U.S. inflation-linked bonds. But more broadly, yes, indeed, inflation is more persistent compared to pre-pandemic levels because of structural forces like geopolitical fragmentation, like net zero transition, and also more broadly thinking about labor shortage as well. Some of the cyclical forces, as we just discussed, goods deflation, for example, have already driven inflation lower from the very elevated levels last year. But actually, even that cannot be taken for granted, because if you look at used car prices, for example, that has been increasing actually since the end of last year. So goods deflation can take us only so far, and even that cannot be taken for granted. And equally for energy prices, it's fallen, it's taken headline inflation lower, but that cannot be taken for granted given the geopolitical risks that we see.
Well, indeed, and that surprise cuts from OPEC Plus as well, underscoring your point on headline inflation and potential impact on gasoline prices. Where does that leave you and the BlackRock team's views then on the next steps for the Fed? And the market's getting this wrong. Presumably that's the call from you to price in cuts later this year. That is a wrong assessment. Are they missing this basically when it comes to the need to go further for the Fed and pricing in cuts towards the end of the year misguided?
Well, we're definitely getting closer to peak. And just now the debate about Fed speech is very much around, are we going to get another hike, or are we going to get pause? But not so much around, are we going to get cuts, right? Markets are hoping for cuts, applying an old recession playbook, expecting central banks to come to the rescue of the economy at times of recession. But typically, inflation is very low heading into recession, and inflation is falling quickly, whereas right now we see persistent inflation. So indeed, we would lean against market pricing for rate cuts later this year and beginning of next year. We think that, yes, the Fed will cut at some point, maybe Q2, Q3 even next year, but the magnitude of cuts will be very, very low. For this year, rate cuts are off the table, and we will lean against any market hopes for that.
Rate cuts off the table for this year may not come through until Q3 of next year, and even when they're done, the velocity or the size will be relatively limited. one of the best read stories yesterday on the Bloomberg was around money supply economists pointing to the sharp contraction in money supply. And here's the pushback to the BlackRock view then, coming from those economists. They say that that is pointing to a potential recession, deflation, disinflation, and that central banks need not just to pause, but need to cut aggressively, given what is happening with monetary supply. What is your assessment of that?
Well, monetary supply and stimulus certainly added to some of the cyclical inflationary pressures that we felt through the course of the pandemic and coming out of it. But there are structural forces behind our conviction for sticky and persistent core service inflation that has to do with, I just talked about labor shortage, for example, and the net zero transition. That is supply driven. So we have moved from a world of great moderation driven by demand factors, economic cycles very much driven by demand factors, and central banks able to mitigate economic cycles effectively through monetary policy tools, to a world shaped by supply, where actually the efficacy of rate hikes and rate cuts is debatable when it comes to certain parts of inflation, core service, for example. So that being the case, we think that actually, yes, the broader money supply backdrop is changing, but that's only one piece of the puzzle. There are supply forces that actually means inflation will be persistent, certainly higher than the levels that we got used to pre-pandemic, which means that central banks wouldn't be free to cut rates as much as they would like to. And I would just also kind of look at, for example, today's CPI print. We're talking about, okay, going from 6 to 5. Yeah. These are really elevated levels. This is way above the comfort zone for central banks. We think that this year out of the question in terms of rate cuts.
Okay, and hence your conviction to add inflation-linked debt. And we'll get more of your calls after the break. Wei Li stays with us, of course, BlackRock Global Chief Investment Strategist. Again, more of her calls coming up in the next few minutes. Coming up, the biggest US banks are planning to set aside about $100 million each to bolster reserves after helping to shore up First Republic last month. We'll get more on that story. Quickly checking in on Prosus. It is the largest shareholder in Tencent, listed, of course, that company, Tencent, in Hong Kong. That stock taking a hit, Prosus under pressure as well, on news that they have put a significant number of shares in Tencent into a clearinghouse in Hong Kong. Suggestions then that they may be selling down more of their Tencent stake. Currently, Prosus down 3.5% in the Netherlands. Stay with us. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
European trading day, gains of 0.1% across the European benchmark. Futures in the US, S&P E-minis flat as we look ahead to that all-important CPI print, inflation print out of the US. Now, the IMF has trimmed its global growth projections, warning of high uncertainty and risks from financial sector stress. Let's bring back in Wei Li, BlackRock Global Chief Investment Strategist. Wei, I want to rip up the script a bit and get straight to your calls. Let's start with credit. You have conviction around credit. Where within the credit space do you want to be adding at this point?
We like quality credit, so IG over high yield still. But currently, given valuation, we have trimmed our almost maximum overweight in US IG to only modest overweights, actually closer to neutral, whereas we keep our overweight in European IG because on a currency hedging and duration matching basis, it gives you about 20-30 basis point of additional spread and yield pickup. So we like credit still over equities, but with a quality tilt and within investment grade credit, a preference for Europe over the US at this point.
And what is the regional bias between EM and developed market equities at this point for you?
Yeah, we also prefer emerging markets over developed market at this point because we see a recession ahead and that is not quite priced in by developed market risk assets. That's actually currently pricing in central banks coming to the rescue. And as we discussed, we don't believe that would happen, at least for this year. So modestly underweight developed market equities with greater selectivity on sectors and factors such as quality. But emerging market, on the other hand, you look at China, the credit data surprising on the upside, PMI surprising on the upside, inflation surprising on the downside. There is more that the authorities can do to boost economy as we come out of the pandemic in China, and broader growth momentum in emerging markets also favor the relative core that we have currently.
Okay, interesting. Yeah, the credit data out of China yesterday really stood out, didn't it, in terms of the impulse there. When it comes to the US dollar, I wonder if you tie that into your view on emerging markets, because the dollar is down on the Bloomberg Dollar Spot Index about 10% since its highs of September. Do you see further downward pressure on the greenback, and to what extent is that going to be supportive to that EM call in the months and quarters ahead?
Yeah, certainly our relative preference for emerging market is predicated on, in part, that the dollar wouldn't surge the way that it did last year. So last year, it was supported by central banks hiking aggressively versus expectation at the beginning of the year. We don't see that happening this year, so that's one headwind taken off. But more broadly, if you think about kind of structural development on the geopolitical front, that actually kind of also points to more competition for the dollar. So both tactically and structurally, there's a case to be made. We're not having strong convictions about weaker dollar, but just having view that the dollar wouldn't surge significantly gives us comfort that we are okay with our relative call for emerging markets at this juncture.
Okay, always valuable insights, and particularly on a day when we look ahead to the CPI print and the inflation print out of the US. Thank you very much indeed, as ever. Wei Li, BlackRock Global Chief Investment Strategist, on the view around DM equities, a preference for EM when it comes to the equity space, at least in the short term, and then, of course, looking for quality investment grade credit. Let's get the Bloomberg Business Flash now with Samuel Etienne. Sam.
Tom, for the first time since 2018, Boeing has taken the jet delivery crown from arch-rival Airbus. The US company says it delivered 130 aircraft in the first quarter, up more than a third from a year ago. Boeing continued to build its cash cow 737s at a steady pace and released already built 787 Dreamliners and MAX jets from storage. Airbus delivered 127 planes over the quarter, fewer than a year ago. And Ernst & Young has scrapped its planned breakup, exposing the shortcomings of the partnership model in professional services. The Big Four accounting firm intended to spin off its consulting business and much of its tax practice into a standalone public company. Leaders of the $45 billion firm known as EY told partners yesterday that an eventual split was still possible, but that more time and investment was necessary to make it happen. And Blackstone has closed its largest global property drawdown fund, known as Blackstone Real Estate Partners X. It secured around $30 billion for the fund that targets deals across sectors, such as how
here in London. Now, the biggest US banks are planning to bolster reserves in a move tied to their unusual effort to shore up ailing lender First Republic Bank last month. Let's get more then with our finance reporter, Tom Metcalf. Tom, how much of a big boost to this, or how big is the change in terms of their reserves as a result of that support for First Republic?
Yes, the figure we're hearing is about $100 million for sort of the biggest banks involved in this move. So basically what happened was they put $30 billion in total across a number of banks into First Republic, and say a bank like a JP Morgan put in about $5 billion. So our understanding is, as a result of that, they're going to have to ramp up their provisions a bit, $100 million. And what I think is interesting about it is the size itself is not really material, but it is kind of going against the grain, saying this is not like a risk-free sort of move by those banks. It does carry some kind of risk. So interesting they're taking that provision, I think, from that point of view.
There's a cost to pay, even though, as you say, you compare it to the balance sheet, and 100 million looks pretty minimal. When it comes to the earnings, and this is really important, the kickoff on Friday, the likes of JP Morgan, Citi, Wells Fargo, what are you expecting? What are you and the team looking for?
Well, there's a lot of earnings, and it's actually a very long earnings period this time. And so, yeah, obviously, when it comes to the JP Morgans, the Citis, you know, I'm going to be looking at, hey, how are those investment banks doing? Is the trading holding up? Has investment banking recovered at all? I think we saw earlier this month, you know, Jefferies coming out with pretty disappointing investment banking results. But for me, actually, this time around, it's more those regional banks that I'm most interested in. So, for example, First Republic, and of course the buyer of SVB as well. Like, will we see SVB results kind of brought into First Citizens?
Okay, some of the smaller banks are going to be in focus, maybe to an extent that they haven't been for quite some time. Help us understand, Tom, what is happening in terms of the Swiss Parliament's actions around UBS, the vote around not guaranteeing, they don't want to guarantee, they don't want to approve government guarantees for UBS's rescue of Credit Suisse. Is this significant? What is it telling us?
I'd say symbolic rather than significant. So basically you've got the lower house effectively saying, we do not want to approve this rescue deal. Now that really has no sort of legal sway because the government has already got that approval from a much smaller group of Parliament. But it just goes to speak to just the kind of turmoil, the anger that's in Switzerland at this move. And, you know, what's happening right now is parliamentarians are trying to reach an agreement so the lower house can kind of feel comfortable with signing off a deal because, you know, sort of visually, this is terrible optics, right? And, you know, everyone wants in some ways the government to kind of have sort of one voice on this.
Okay, so the political fallout continues for Switzerland as a result of that UBS takeover of Credit Suisse. Tom Metcalf hitting all the big banking stories for us once again. Thank you. Coming up, we are going to look at your stocks on the move, including Volvo rallying today. Volvo Group, the Swedish truck and bus maker, delivers a strong first quarter result. We'll have more on that next. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. 23 minutes into European trading day. Happy Wednesday. Midweek, you're seeing gains of 0.1% across the European benchmark. US futures, S&P E-minis are flat. Nasdaq futures down 0.1%. We're looking ahead, of course, to that important CPI print out of the US. The estimates from the Bloomberg survey, 5.1% year on year for the month at the headline. It's core as well, of course, that remains important for the Fed and officials there. Let's get to our stocks to watch now, though, with Joe Easton from our equities team. Joe, what are you zeroed in on?
Right, Tom. So the first stock we're looking at today is Volvo, absolutely rocketing, the best performing stock on the stock 600 today, up around 8%, was up around 10% earlier. Not only is their profit beating expectations by around 45%, but they're reporting margins at around 18%, whereas the street was only looking for 12%. Some analysts are warning that this might be just due to a bit of some supply chain issues easing, therefore potentially a one-off. There's obviously a bit of concern around the demand for trucks as the construction outlook darkens, but for the moment, that's the best performing stock we've got today, Tom.
And Joe, you're also looking at L'Oreal.
So L'Oreal going the other way. They've been downgraded over at Deutsche Bank. The company, they're saying that they don't expect L'Oreal's growth in the US to continue at as quick a pace as it has been. The China business is a bit stronger. That's helping the stock to outperform. But really, Deutsche Bank also noting now that this valuation is looking really punchy. Trades at around 20 times earnings, whereas most staple goods firms are down at around 14. And that's another reason they're cutting that stock. And that's one of the large cap decliners we've got today, down around 0.9%.
Okay, you've also got money and passport printer De La Rue in your focus.
So De La Rue, this is getting absolutely slammed here in London. The worst performing stock on the London Stock Exchange down today, losing a third of its value, as we can see on the screen. Another profit warning. This is a company, as you mentioned, that prints money. They've got a big contract to make the new UK banknotes with Prince Charles on them, but they're saying today that banknote demand is at a 20-year low as many countries continue to go almost cash-free, and that's once again hurting their earnings. De La Rue really getting hurt today, Tom.
Okay, the king not doing much to lift the fortunes of De La Rue. And finally, you've got Metza in focus for us.
That's right. So this one is Metza Board over in Helsinki. Now, this is a box company. They're warning today of weak demand for pulp and also saying that the economic slowdown and online retail boom kind of leveling out is hurting the demand for boxes. We saw that increase during the pandemic, and this is hitting all those box companies in Europe today, including Smurfit Kappa over in Ireland and also a couple in London as well. That one down around 3%, but was down about 6% earlier. That's Metza Board in Helsinki.
Okay, Bloomberg's Joe Easton running through some of the idiosyncratic corporate and equity stories for us this morning. Thank you very much indeed. Let's check in on these markets then on a big day, of course, when it comes to inflation and the direction then of travel for the Federal Reserve. You see some dispute, at least disagreement among senior Fed officials as to the next hike and whether there is a need for one coming through for May. Currently, across the benchmark here in Europe, you're seeing gains of about 0.1%. Futures on the S&P E-minis are flat. Coming up, Megan Green, Global Chief Economist at the Kroll Institute, will become the latest Bank of England policymaker. We'll get the details next. This is Bloomberg.
go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site, whereas this we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are the top stories. US headline and core CPI readings will be poured over for clues on the course of Fed interest rates. Equity and Treasury moves are muted before the report. Hike versus hold. Fed officials signal divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are planning to bolster their capital reserves. Let's check in on these markets then. Yes, they are treading water then ahead of that all-important CPI print. The Bloomberg survey of economists expects that number to come in for the month of March. The headline year-on-year for 5.1%, down from 6%. We'll see if that comes through. So we're calm, at least treading water, as I mentioned, across the equity markets. You would expect some volatility possibly to come through, and Goldman Sachs are flagging that as a potential risk to these markets, saying that if you get a print of 6% or at least above 6% year-on-year for CPI, you could see moves of 2% or more lower for the S&P. So we build up to that CPI print. We'll get more details with Jamie Rush just in the next minute or so. Across the benchmark, you're seeing then very modest gains of 0.1% across the benchmark here in Europe. The DAX adding 29 points so far in the session, up 0.2%. Here in the UK, the FTSE 100 gaining 0.2 as well, up 0.3%. We'll see how things are breaking down sector by sector on a day again when it's a little bit muted across the European equity session. Interesting to note that over in the Asian session, Hong Kong was in focus, particularly those Chinese tech stocks listed in that city, given the news that Prosus has shifted some of their shares in Tencent into a clearinghouse there, signaling that maybe they're going to sell down more of their stake. They are the largest shareholder in Tencent. Prosus also under pressure in the session today. Across your sectors then, real estate at the top of the list, the big gainer across the sectors, just gaining 0.8%. Bottom of the list, the biggest loser so far in the session, basic resources down 0.7%. A little bit of pressure coming through on iron ore after the gains that we saw yesterday, but it's worth noting that Brent and WTI are up again in the session. In terms of US yields, you have the 2-year still holding above 4% as we lead in to that CPI number. So it is the countdown, as we mentioned, of course, to that US inflation print for March, due out later today. Let's get the latest then with Jamie Rush from Bloomberg Economics. Jamie, what are you expecting when it comes to US CPI?
Well, at the moment, we're expecting pretty much the same thing as the market, so a print of 5.1% on the year. You know, we heard that Goldman Sachs report about what if inflation doesn't fall, what would it do to equities? Well, I mean, for inflation not to fall, something very surprising would have to happen, because we know that there are base effects coming out of the annual comparison. We know that energy costs are lower this month, so that's all going to be pushing down on the headline rate. So if inflation didn't fall, it would be a real shock. The Fed, we think, is going to be focused on core. And so we're not expecting the Fed to cut rates this year. We think that persistent, sticky inflation at the core level is going to keep them on hold right through to the beginning of 2024. financial stability risks, of course, that could change the picture.
So they go. You think they go again in May, the Fed?
Yeah, another 25.
With another 25. It was interesting to hear from Whaley from BlackRock saying she doesn't think, and they don't think, that cuts are going to come through potentially until Q3 of next year, and even then, relatively modest. When it comes to euro area inflation, we had more warnings from officials, French finance minister, around what is happening and the stickiness of inflation in the eurozone. Where do things stand on that front? Are you seeing any evidence of a significant or at least sustained downturn on the inflation pulse out of the eurozone?
So I think the ECB's kind of boxed itself into a corner because it's basically said that it's going to keep hiking until core inflation comes down. And the trouble with that is that core inflation isn't going to come down over the next few months, over the summer. And there's some statistical oddities, some weird quirks about the weights that mean that core is just going to keep high for at least until September, we think. So that basically means there's always going to be this pressure for them to hike over the coming months. We think they will step down to 25 basis points, but they'll probably keep going. Thereafter, though, I mean, the picture is quite different from the US. You haven't seen the sorts of wage gains that have happened in the US or in the UK, in the Eurozone. It's much more moderate. There's been a much more sort of equal division between the sort of pay gains that have been recorded by households relative to what firms have been doing. So I think that the outlook is actually more benign for underlying inflation in the Eurozone.
Okay, underlying inflation more benign, but you don't see that coming down significantly in terms of the headline until maybe September, so pressuring the ECB to go further, but 25 basis points is the call there from Jamie Rush. And same, Jamie, as ever, thank you with the preview of US CPI and as well a touch on the dynamics of inflation in the Eurozone. Let's get the Bloomberg First Word News now with Sam Etienne. Sam.
Tom, UK police say they're investigating the Confederation of British Industry following allegations of sexual harassment and rape among staff. The City of London police say they approached the CBI, Britain's biggest business lobby group, after the Guardian newspaper reported allegations made by more than a dozen women who have worked at the organisation. The CBI says it's liaising with the police and would cooperate fully with any inquiries. And the Swiss Parliament's lower house has symbolically voted against approving 109 billion francs in government guarantees for the UBS Credit Suisse deal. While lawmakers can do little to derail the takeover, they're still likely to push the government to overhaul too big to fail rules and pursue legal action against Credit Suisse's management. And French Finance Minister Bruno Le Maire says Europe mustn't be pushed around due to a rivalry between the US and China. Speaking to Europe One Radio, he said being a US ally doesn't mean that France should be against Beijing. His comments come after President Macron's visit to China last week. And a pair of Michael Jordan's trainers from his infamous Last Dance season has sold for, get this, $2.2 million at a Sotheby's auction. That makes them the most expensive sneakers known to have sold, topping the previous record of $1.8 million for a pair of Nike Air Yeezy shoes. Jordan wore them during Game 2 of the '98 NBA Finals. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom.
Sam, thank you very much indeed with the latest on sneaker price inflation. We appreciate it. Let's get back to what's happening with the UK then. The Treasury has announced that Kroll Institute Global Chief Economist Megan Green will join the Bank of England's Monetary Policy Committee. Green takes up the post in early July. She will be replacing Silvana Tenreiro, one of the most dovish policymakers on the panel. So the question, of course, around how this changes the mix and the views at the BOE. Let's bring in Bloomberg's UK correspondent, Lizzie Burden. Lizzie, what do we know about the MPC's newest member?
Well, she's got a financial services background, an academic background. It's a delicate time on the Monetary Policy Committee at the moment because we're nearing the end of the tightening cycle. As you know, we've had 11 straight hikes so far. This is a replacement for Silvana Tenreiro, as you say. She's at the dovish end. You've got Swati Dhingra there as well, battling it out with Catherine Mann at the hawkish end. But fortunately, Megan Green is a regular on Bloomberg TV, so we've got a bit of an insight into her thinking already. Take a listen to one of her recent interviews.
The Fed and every other central bank would like to think that they have very distinct tools for price stability and then other tools for financial stability. And so the price stability tools include rate moves, the balance sheet. And so the Fed hopes that they can continue to hike rates while also supporting the financial system through their tools for financial stability, which includes macro-pru, regulation, supervision. The thing is, the two get blurred at a certain point because financial stability weighs on macro stability and therefore price stability.
So that's really in the US context, but you can tell that she has concerns about the impact of monetary policy on financial stability, and it's a hot button issue in the UK, given all that's happened with Credit Suisse and Silicon Valley Bank.
Her predecessor, or her soon-to-be predecessor, set a pretty high bar when it comes to dovishness. Is she likely to match that? What is the impact likely to be then on the committee?
Yeah, you're right. It's harder to be more dovish than Silvana Tenreiro. She's voted to hold at the past 3 meetings. She's already been recently talking about cutting before she leaves the committee. So it's hard to see it as being anything more than a hawkish tilt with Megan Green coming in. The thing is that we're nearing the end of the tightening cycle. By the time Green comes onto the committee, we might already be done. And indeed, Bloomberg Economics says that the committee is already done. What might be more interesting for UK viewers is perhaps Megan Green's Brexit views. She's been pretty anti-Brexit on Twitter. And maybe more influential for the Monetary Policy Committee's balance will be when Ben Broadbent, the Deputy Governor, departs next year, because he's been an incredibly influential thinker. And you can see it in every single vote since he's been on the committee. He's been with the majority, or perhaps I should say the majority's been with him.
Okay, fantastic stuff. Thank you very much indeed. Lizzie Burden on Megan Green, set to join the BOE, and no doubt lots of us will be poring over her social media and previous interviews, of course, with Bloomberg, to get a sense of where she stands on these issues. Coming up, Twitter ceases to exist as an independent company. We will bring you more on Elon Musk's latest move. That is next. This is Bloomberg.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in focus. Today on Bloomberg.
facing the highest inflation in the European Union at around 25% year-on-year. And Hungary also has the highest effective central bank policy rate in the bloc at 18%. The government in Budapest has been calling for interest rate cuts to try to stimulate an economy already in recession. But monetary policymakers have been pushing back, citing the need to tackle inflation. The challenges are political and geopolitical as well as economic. The Central European country depends on energy imports from Russia and is facing a high bill. That's amid a dramatic weakening of the country's currency, the forint, last year. There's also the issue of EU funding. Prime Minister Viktor Orban's government is in talks with the EU to try to access 37 billion euros of funds. Those are currently frozen over alleged violations of the EU's fundamental rights and perceived politicization of the court system. But in the meantime, policymakers are left with a tricky tug of war as the next policy decision looms later this month on April 25th.
And that was Bloomberg's Max Ramsey. We did get Hungary's inflation data for March earlier this morning. It eased slightly from February, but still came in hotter than economists were forecasting at 25.2% year on year. Welcome back to the Open. We are 44 minutes into your European market open. Checking in on the trading session then. Gains of 0.1% across European equities. S&P E-minis are flat. Nasdaq futures down by 0.1%. The build-up, of course, and the look ahead to that CPI print out of the US. So some investors certainly treading water ahead of that. The expectations, the Bloomberg survey, you're going to get 5.1% on headline inflation year on year for the month of March, down from 6% in the previous month. Speaking to BlackRock earlier on Bloomberg TV on this show, saying that markets are wrong to price in cuts by the end of this year. She and the team at BlackRock do not see that happening until at least Q2 or Q3, because inflation, in their view, will remain sticky and well above that 2% target for a prolonged period of time. Let's get back to one of the big corporate stories of the moment then, at least the latest when it comes to Elon Musk. The billionaire announcing and declaring that most of the advertisers who abandoned Twitter after his $44 billion acquisition have actually returned. That is the highlight of a rambling Twitter Spaces interview with the BBC that played out before millions of listeners. Let's bring in Bloomberg's Craig Trudell now for the take on that interview, but also the news that Twitter essentially no longer exists, at least in some legal sense. Craig, what do we make first of that? And then we'll get maybe your views on this interview with the BBC.
Yeah, so we know from a few months back that he incorporated a few holding companies. He has this thing about X. It has some sort of science fiction connotation. There's actually a great podcast that was done a few months back about his sort of adherence to science fiction and how it sort of explains everything about him. It's really unclear what the heck this means in terms of Twitter ceasing to exist legally as a company and being folded into this holding company. We do know that he's talked about wanting to turn Twitter into an everything app, and he's even sort of alluded to the idea that maybe at some point sort of combining his empire into these holding companies, maybe it makes sense, maybe it doesn't. He's kind of waffled back and forth on that. I think the sort of short answer there is, who knows?
We still don't know. A WeChat-style super app is what he's kind of flagged in the past. So maybe this is one step towards that. Yeah, good luck indeed. I used that for about 5 years. You can do everything. Buy your tickets, pay your bills, save your money. But this could be one substantial step towards that, or it could just be another example of confusion in the Musk empire. Talk to us about that interview then. Did anything stand out? Anything new from Musk on the back of this?
I wish I were in the seat of the BBC interviewer, because I would have asked him to name some names of some advertisers who've apparently come back or told him he's coming back. Because I think if we really look at the sort of nuance of what he said, he did sort of not necessarily allude to them firmly coming back, but saying they would. That doesn't really match up. I'm like a lot of journalists. I spend too much time on my Twitter feed. That doesn't match up with what I'm seeing. I'm still seeing a lot of kind of spammy ads. I'm not seeing, sort of A-list advertisers coming back. We know anecdotally, there was a report recently by Semaphore. Musk is going to speak at this conference of marketing executives and advertising folks. And within this organization that invited him to speak, even folks in control of these big marketing budgets like McDonald's, talking about sort of being uncomfortable with inviting him to speak. He's still a very controversial figure. He's making off-color jokes just in the minutes before I came on air to talk about him. I do wonder whether people are really sort of flocking back to the platform as he suggests, and just how healthy this company is when, after all, one of the things that he's doing sort of behind the scenes is not paying Twitter's bills. He's not paying rent in San Francisco. He's not paying severance. He's, taking everybody to court and saying, if you want money from this company, we'll see you in court, essentially.
It's still a long way from
how lasting is this? Yeah.
It's still a long way from being on a sure footing. Making off-color comments and remarks, you stun me, Craig. Briefly, before we let you go, how is Tesla doing? They're cutting prices. Does that continue? Is the car business at least holding up?
I have to wonder if you're in the market for a car, why you would buy a Tesla right now and not wait 3 months, 6 months, because what we've seen thus far this year is, price cut after price cut. We know sort of the writing is on the wall in terms of the amount of capacity that's coming online. They're still ramping up in Germany. They're still ramping up in Texas. So, the sort of simple supply-demand dynamics here is demand is only growing so quickly, whereas supply is growing. To me, that means, price is only going to keep coming down. And, to what extent is he kind of, cutting his nose off to spite his face by, continuing to cut prices and giving people an incentive actually to hold off and wait until, you have more confidence that prices are going to stabilize here.
Okay, potentially further price reductions coming through for Tesla. Craig Trudell, thank you very much indeed. On Twitter, Elon Musk, and of course the fortunes of Tesla as well. Thank you. Coming up, luxury watches see a slowdown as top Swiss CEOs warn of softening demand for the high-priced timepieces. We get into that story next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. 52 minutes into the European trading day. Gains of 0.1%. So holding on to that level for European equities. 52 minutes into the trading session. Gains now for the S&P E-minis. Futures in the US up 0.1%. Across your sectors, top of the list, real estate gaining 0.8%. Bottom of the list, Technology just down 0.9%. Let's take a look at the key things then markets are watching out for today. It is, after all, CPI day. We're going to get US March inflation print. That comes through 1:30 p.m. UK time. Mark that down in your calendars if you haven't already done so. Bloomberg Economics expects data to show core price gains remain sturdy and retail sales to show slowing growth momentum. Then at 2 p.m. UK time, Richmond Fed President Thomas Barkin expected to speak at an annual conference on investing in the rural economy. We'll see where he lies in terms of the debate that we're seeing unfold between these Fed officials on the next rate hike or not from the Fed. We're also going to get Bank of Canada rate decision. That comes today, 3 p.m. UK time. That was announced previously that it's going to be holding rates steady, currently at 4.5% if inflation is easing on par with forecasts. And at 7 p.m. UK time, we're going to get the latest Fed minutes. Important because those came through, of course, at a time when they were assessing the banking crisis. Traders have now boosted the odds of another quarter-point Fed hike next month. Right. Luxury watches are seeing a slowdown. The heads of some of the biggest watch brands, from Patek Philippe to Oris, say demand for luxury timepieces is starting to decline from an unprecedented industry boom during the pandemic. Joining us now is Bloomberg's Andy Hoffman in Geneva, who's been working on this story. Andy, thanks for joining us. What have CEOs been saying then about the demand that's coming through?
Yes, good morning. Well, I think what's very important to remember here is that the Swiss watch industry and the luxury watch industry in general is coming off basically its strongest period in history, at least by value. I mean, you know, Swiss watch exports were about 25 billion francs last year, which is a record for the industry. But what we're hearing from some of the top CEOs, including Thierry Stern, who is the president and chairman at Patek Philippe, the legendary watchmaker here in Geneva, coveted by collectors, is that there are signs that things are starting to slow down. There's a little bit of softness in terms of demand from customers for these luxury timepieces, some of which start at about 30,000 francs. We also heard a similar sentiment from Rolf Studer. He's the CEO of Oris. They're an independent watchmaker here in Switzerland. They make, tough, cool tool watches. And he was saying that while the consumer demand remains strong, there is the retailers are starting to be a little softer in terms of their restocking orders. Julien Tournaire from Zenith, he said that there's still a lot of uncertainty about China and demand, which used to be the biggest market for Swiss watches. Now that's been taken over by the US.
And Andy, just very briefly, any sense as to whether this is just a temporary blip or kind of more prolonged slowdown?
Yeah, well, I mean, that's what everybody's waiting to see. And, it will take time for that to play out. Obviously, there's the war in Ukraine. There's economic uncertainty, particularly in the UK and the US. And we get a good sense of that every month with Swiss watch exports. And so we'll be watching that to see if they can meet the record that they made last year.
Andy Hoffman in Geneva with that story. Thank you very much indeed. Coming up later today, we're going to be at the IMF World Bank spring meetings, where we'll be joined by the Reserve Bank Governor of South Africa. That interview at 6:40 p.m. UK time. Later, we're also going to speak to UK Chancellor Jeremy Hunt at 9:40 p.m. UK time, 4:40 p.m. in New York. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. US headline and core CPI readings will be pored over for clues on the course of Fed interest rates. Equity and Treasury moves are muted before that report. Hike versus hold, Fed officials signaled divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are planning to bolster their capital reserves. Let's check in on these markets, of course. The drumbeat towards that CPI print around 1:30 p.m. UK time. The estimates from the Bloomberg survey, 5.1% on the headline basis year on year, coming down then from 6%. But BlackRock's Wei Li telling us markets are wrong to price in cuts at the end of this year. Those will not come through, she and the team at BlackRock think, until at least Q2, possibly Q3 of next year. Across the European benchmark then, still holding on to these gains of a little over 0.1%. Bit of treading water, but still, you are seeing some upside pronounced, particularly in the FTSE 100 and over in Spain. On the Spanish IBEX, gains of 0.6%. Futures in the US pointing to very modest gains there of 0.1%. The Nasdaq futures, by the way, just currently down by 0.1. Euro dollar 109, again there of 0.1%. We continue to watch dollar weakness and whether that is sustained on the back of CPI. Goldman Sachs, by the way, warning that if you get a print above 6% for the month of March on a headline basis year on year, you could see downside of at least 2% for the S&P stateside. The 2-year remains above 4%. Here's the picture on the map then. It's the Spanish IBEX that is a standout across these indexes. And again, the FTSE 100 holding up fairly well, gaining 35 points in the session so far today, up 0.4%. The Spanish IBEX adding 57 points. Every major index in Europe holding on to gains an hour into this trading session as we count down to that all-important inflation print. Stay with us on that topic, though. Investors are counting down, as I say, to that US CPI number. Goldman then, as I mentioned, flagging a potential drop of at least 2%, again, if the year-on-year rate comes in above that previous reading of 6%. Let's bring in Valerie Teitel then, who's been going through the details around how we look at this CPI print out of the US later today and the potential implications, of course, for the Fed. What is in focus for you, Valerie?
Well, let's remember CPI releases have been some of the most volatile days in the last year, so buckle in for today. But we're likely to see some moderation, especially when it comes to headline inflation, dropping from 6% last month to 5.1% is the consensus estimate today. A lot of the market attention is going to be on the core CPI number, especially the month-on-month that is also estimated to moderate from 0.5% last month to 0.4% today. Now, even within the core CPI basket, traders are going to be looking at the breakdown in between core goods, core services, and the super core metric that Powell loves to talk about, the core services ex-housing component. As you know, we've seen core goods dropping like a stone in the last 12 months, but this disinflation impulse is really yet to impact services. That's those blue bars there in the graph on screen. It has remained quite sticky, and it was only back in February that Powell told us that this services inflation was his main worry. Now, don't forget, we also get the Fed minutes later tonight, and I'm going to be looking very closely on the discussion of what will they weight more. Will they weight this economic data, this CPI data we get today, and the employment data last Friday? Or will they perhaps have a discussion on weighting those lending surveys a bit more when it comes to the decision in May? Remember, in the last 2 days alone, we've gotten some pretty substantial lending surveys showing credit availability is tightening when it comes to both small businesses and consumers.
So given all of that, it's probably not a big surprise that you do get divisions, or at least some dispute amongst top Fed officials. Is it changing the market pricing regarding the next move from the Fed?
Look, it hasn't really yet. We're pricing 3 out of 4 chances of a final Fed hike in May to 5.25%. But we heard from Fed's Goolsbee yesterday. He sounded quite dovish. He very much suggested in his Q&A that he wants a pause at the Fed's next meeting in May, urging prudence and patience when it comes to raising interest rates. He wants to be patient and to see the assessment of how much last month's banking turmoil will contribute to tighter lending conditions. This stands a bit at odds from what we've heard from Mester, Bullard, and Williams only yesterday, who have made comments saying that they're not necessarily swayed by the banking crisis when it comes to hiking rates, and paint a bit of a picture that the banking woes are behind us for now. So there is a bit of division, and we might see more hints of that division within the Fed minutes. You know, the May meeting, I still think is very much a live one. We do get some more important lending surveys before that meeting, especially the Senior Loan Officer Opinion Survey that the Fed runs quarterly. The Fed will have that data before they decide in May.
Okay, May is still live. Looking ahead, of course, to the CPI print out later today, and of course, passing those comments from Fed officials. Valerie Teitel from our markets team, thank you. Now, Fed officials have sounded those divergent notes, as we flagged, about the next policy move. John Williams saying that more work is needed to tame inflation. But Chicago Fed Chief Austin Goolsbee calls for prudence and patience.
Today, what I want us to think about is why I think that at moments of financial stress like this, the right monetary policy is really caution and watchfulness and prudence.
Okay, prudence there, the call from Goolsbee. Let's bring in Daniela Antonucci then, Chief Economist at Quintet's Private Bank. Daniela, thank you for joining us in the studio. Let's start with your views on inflation. And I want to really zero in on the question marks around the goods part component versus services. Are you seeing any evidence that the impact of rate hikes is starting to be felt on the services component that we know is so important for Jay Powell?
Exactly, very, very important. The short answer is not so much. The shelter or housing component is still very firm. And I think even if it's beginning to slow, and it should slow, what matters is the level. It's very, very elevated. That suggests to me that the Fed should raise interest rates in May, even if there is some degree of tightening in credit conditions. Yes, it should be cautious. Yes, maybe it should pause after that and see the feed-through of interest rate hikes and tighter financial conditions into the real economy. But the job is not done yet, and there is upside risks, I think, to the core number later today.
So what is the time frame that you are looking at regarding services, and when you expect that to come down, if indeed the Fed goes for another 25 in May?
Okay, sure. So first of all, I think it's not just one print.
Okay.
Central banks have confirmation biases, and that's the right thing. They want to see that a whole host, a whole range of indicators show that deceleration. Towards the end, and I think we'll have at that point the core measure just above 3.5%, but still rather elevated. It makes sense to pause, I think, after May. Now we are entering that phase of a year and a half after the first rate hikes when the tightening in financial conditions feed through. So a pause should be warranted after the next rate hikes. But I think the Fed shouldn't cut like markets price in the second half of the year.
Okay, so potentially an upside surprise on the CPI print later today. You're expecting maybe inflation around 3.5% by the end of this year, and the Fed should hike and then pause for the rest of the year to allow those hikes to come through and have an impact. When it comes to the headline, do we dismiss that and put that to one side? How concerned should we be about the OPEC Plus surprise cut and what that could mean for gasoline prices in the US and the impact on headline inflation? Are you bracing for a tick-up in headline inflation in the months ahead?
Okay, sure. I think we shouldn't dismiss the headline print. Of course, there is this energy disinflation. That's just about what's happening. Food prices, for example, are still very firm. But motor fuels, gasoline prices, yes, they are coming down. There is that feed-through that we are seeing. It is important for inflation expectations. And also, it is important for second-round effects. When they feed through, so the Fed feels compelled to respond, and the other way around is true as well. So we shouldn't dismiss it. Of course, headline inflation has been coming down quite a bit from a very high level, just above 9% to 6 and 5.25 or 5.1% now, but that too is still quite elevated.
When it comes to the Eurozone, our team of economists here at Bloomberg suggesting their analysis, at least, that you don't get a sustained turn down in inflation across the Eurozone until possibly September. And then that, to some extent, boxes the ECB in, given its commentary, given its commitment to further hikes to get that inflation print down. What is your assessment of how much more work is needed from the ECB?
I actually think the Eurozone has a worse inflation problem than the US. Core inflation looks stickier. Headline overall inflation is more elevated. The ECB has a high to a lesser degree. Of course, we need to take into account these bouts of financial instability. These are important air pockets. If that gets worse, the ECB too should moderate, and I think they will, the pace of rate hikes. Eventually should pause as well. But if that doesn't happen, I think there's more upside to policy rates in the Eurozone than in the US.
Does that raise the risk of a policy mistake and misstep from the ECB?
It could increase the risk of a policy mistake. Of course, the policy mistake is when a central bank tightens financial conditions when the cycle is just about to turn. But at the end of the day, there is a degree of disinflation that's very minimal in the Eurozone. The economic data have been holding up a little bit better than expected. And so the ECB looks set to raise rates. I think they will scale back the pace of hikes as well to a quarter point, but there is upside to that.
Okay, what is the quintet view then on how to position for a sustained inflationary environment? What is the opportunity, or at least where is the hedge within that environment?
Okay, so the first point is that generally speaking, we are defensively positioned. We own higher quality bonds, both sovereign and corporate bonds, and more than normal, and a lesser amount of equities. All right, so that's the first bit. Secondly, we recently bought inflation-linked bonds precisely to hedge or to protect against the scenario of stickier than expected inflation. And generally speaking, also, I think we're looking at areas of the world where there isn't much of an inflation problem. One is China. China is reopening. It's today where we were in the West a year and a half to 2 years ago. And so we have increased our equity exposure to Asia Pacific as a whole because China is at a different point in the cycle.
Okay, really interesting. Defensively positioned, a little bit of upside possibly coming through from Asian equities powered by China, and maybe adding in terms of inflation-linked bonds, US tips in favor from Daniele Antonucci, Anton Ucci, I should apologize for the mispronouncing your surname there, Chief Economist at Quintet Private Bank. Really important and insightful comments there. As we lead up, of course, that print out of the US and the views on the ECB, how to position with a sustained inflationary environment. Coming up, the biggest US banks planning to set aside about $100 million each to bolster reserves. We're going to impact on the story, the details, what it could mean for the US banking space, the price that's being paid to support those smaller lenders. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Hi, Tom. The Swiss Parliament's lower house has symbolically voted against approving 109 billion francs in government guarantees for the UBS Credit Suisse deal. While lawmakers can do little to derail the takeover, they're still likely to push the government to overhaul too big to fail rules and pursue legal action against Credit Suisse's management. Now, UK police say they are investigating the Confederation or British industry following allegations of sexual harassment and rape among staff. The City of London police say they approached the CBI, that's Britain's biggest lobby group, after the Guardian newspaper reported allegations made by more than a dozen women who have worked at the organisation. The CBI says it's liaising with the police and would cooperate fully with any inquiries. French Finance Minister Bruno Le Maire says Europe mustn't be pushed around due to the rivalry between the US and China. Speaking to Europe One Radio, he said being a US ally doesn't mean that France should be against Beijing. His comments come after President Emmanuel Macron's visit to China, and that was last week. Global News powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Tom.
Leanne, thank you very much indeed. Now, the biggest US banks are planning to bolster their reserves in a move tied to their unusual effort to shore up ailing lender First Republic Bank last month. Let's get more with our finance reporter, Tom Metcalf. Tom, how big is this reserve boost? What should we read into it?
Yeah, so in terms of size, we understand it's about $100 million for, say, the biggest banks involved in this move to leave deposits with First Republic. So look, for a JP Morgan, a Citigroup, $100 million provision isn't going to massively change their earnings. But what I think it's interesting is basically it shows that, this move was not without cost. There is some risk associated with leaving deposits with the First Republic. So, interesting to hear them making this change.
And the fate of First Republic is still somewhat unknown as well, isn't it? When it comes to the earnings picture, kicking off Friday, banks, what are you looking at?
Yeah, well, so for the big ones, it's like, how are the investment bankers doing, how are the traders doing? Of course, what are they looking at net interest margin? I mean, I think the outlook will be really interesting. What are they saying? Is there sort of more economic turmoil ahead? Do they feel the bank crisis has passed, etc.? And then, normally we don't pay as much attention, but the regional US banks are probably going to be in the spotlight, given stuff like First Republic, given SVB. So we'll have a lot of coverage on them as well.
As we switch back the focus to UBS and Credit Suisse, the US, or the Swiss Parliament, I should say, coming in with some decision-making, how consequential is it? What does it say about the body politic of Switzerland right now when it comes to that deal?
I think it shows the divisions, right? So it's largely symbolic. This deal is going through whatever, but it's pretty embarrassing that you've got the lower house of parliament saying we would not have approved this deal. So look, what's happening right now, this session is continuing, and I think everyone in Switzerland's sort of establishment is trying to find a way to get this lower house on board. So, perhaps there's sort of some kind of, offering they can give to them to make them sort of a bit more comfortable with the offering. So at least symbolically, everyone's on the same page.
Okay, symbolic for now rather than substantial, but we continue to keep across that session that continues, as you say, in Switzerland. Thank you for breaking down what is happening across the US banking space and, of course, in Switzerland as well. Bloomberg's finance reporter Tom Metcalf. Coming up, US Defense Secretary Lloyd Austin says Washington will not stop until it tracks down how classified documents on Ukraine were leaked. We've got the details next. This is Bloomberg.
CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I would also caution at this point that we not draw too many conclusions.
This could be an influence operation by somebody, we don't know who. And once you get into the world of counterintelligence, it makes being in a hall of mirrors look easy. It's very complicated.
Former US National Security Advisor John Bolton there on the US security leak. And US Defense Secretary Lloyd Austin says Washington will not stop until it tracks down how a trove of classified documents appeared online. For the details, let's bring in our senior reporter for international affairs, Mark Champion. Mark, what is the latest then on this US intelligence leak?
Right, so we still don't know much about how these documents got into the public domain, but increasingly we know more about the substance of these various documents, with the proviso that any of them could have been doctored. We simply don't know. We know that in principle the Pentagon is acknowledging that these are the real deal. But they may have been doctored afterwards because they've been all around on the internet. So, in terms of substance, what's kind of new is that, the Washington Post has reported that Egypt was planning to produce 40,000 rockets for Russia, which would be a huge embarrassment for the US and a big problem for their relationship. The US has said that they're not aware of any of those actually being delivered or made. And the Egyptians have said on local media that it's false. Nevertheless, that's out there. Equally surprising is a document released reported by Reuters, where they are saying that Serbia has actually provided weapons to the Ukrainians. Serbia is a big ally of Russia and has refused to join Western sanctions. So that is also a big surprise, potentially a problem politically for the Serbian regime. And then after that, we also had another document which suggested that the Hungarian Prime Minister, Viktor Orban, had said that he saw the US as among the top 3 threats and opponents to his party, Fidesz. So all those things coming out on top of other stuff that we already saw.
Really fascinating, again, if verified. The other reports coming through that there are British and US special forces on the ground in Ukraine. How surprising is that?
Right.
And what does that do to the Russian view that they are fighting NATO, as they have espoused?
Right. Well, they will certainly use this to make their case, but they've been arguing that from day one almost. But in terms of the substance, not a huge surprise. We knew that Western troops and special forces had been involved in training the Ukrainians for some time. The fact that there are 50, according to this report, UK special forces in Ukraine working with the Ukrainians, that is a pretty big number in terms of special forces. In terms of the UK special forces, that's quite a big number. So they're obviously fairly involved. What they're doing exactly, we can't say. That's the US and France had only about 15, 14 respectively. So that's quite a big number for the UK and won't help an already very problematic relationship between the UK and Russia.
Okay, Mark Champion, thank you very much indeed on the latest when it comes to this intelligence leak, our senior reporter for international affairs. Coming up, political chaos and a crippling energy crisis. Is South Africa still investable? We have an important interview coming up. This is Bloomberg.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
US headline and core CPI readings will be pored over for clues on the course of Fed interest rates. Equity and Treasury moves, they're muted before that report. Hike versus hold. Fed officials signal divisions over their next policy decision. Plus, sources say big US lenders that shored up First Republic Bank last month are now planning to bolster their capital reserves. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's switch focus now to what is happening in one of the key emerging markets. Rolling blackouts, record high unemployment and political chaos, crippling South Africa's economy and arguably its global reputation, at least for now. So is the country still investable? Let's bring in the CEO of one of the nation's leading banks, Richard Wainwright from Investec Bank South Africa. Richard, good morning. Thank you for joining us out of our bureau there. Let's start with that question then. The crisis on the energy front, the power cuts, the load shedding, of course, the political scandals and the downgrades to growth. Is South Africa still a place where investors should be putting their cash to work?
Good morning, Tom, and good morning to your viewers. Thank you for having me here. Yes, the challenges that you've just mentioned are very acute and very serious. It does make South Africa an incredibly difficult investment environment now, both for international capital and, in fact, domestic capital. The energy crisis, and I'm glad you referred to it as an energy crisis, we've had around for some time now. 14 years of load shedding, which doesn't seem to be ending and, in fact, is intensifying it. We expect it to intensify over the next 2 years and then slowly start to shift down in the following 2 years, as the private sector, in fact, starts to take up the capacity that Eskom has lost. So a very challenging environment, both external factors as well as domestic factors, which you've just mentioned. So a very difficult investment environment at the moment.
Yeah, a challenging environment, and that's remarkable in terms of the time frame. 14 years of load shedding, and your forecast that we're going to get another 2 years of this. What is the impact on your business, Richard?
Yeah. Well, for us, as you said earlier, quite a sizable domestic player that's very niched, we've done particularly well. So coming out of load shedding, coming out of the global crisis, COVID crisis, the domestic banks, including us, have done reasonably well as we've recovered from that. But going forward, we think that the macro environment is going to be very difficult. As Investec, we're a niche player. And we look to try and extract growth even in a difficult macro environment. But in aggregate, it's going to be a very challenging environment for all the banks here to eke out some real growth in this economy.
What actions on the energy crisis, on the load shedding, what are the specific actions that you would want to see from your government to address that challenge?
Well, I think what the government has done to date, which is basically enhance the private sector's capacity to invest in power generation, is now, the caps have been lifted, is now unlimited. So over the next 2 to 3 years, we are going to see a large amount of domestic private investment come into the space, which will ease the burden on Eskom. My sense is that over the next 10 years, if I can stretch it out that far, is that Eskom as a generator in this domestic environment will become quite a small player. What government does need to do, however, is increase the capacity on the grid. The transmission grid needs, in our estimation, approximately 50 billion rands worth of investment to increase its capacity. That will still be a limiting factor. We think that the private sector will, as I said, invest in the generation side. Most of the obstacles for that have been lifted now. The remaining obstacle will be the size of the transmission grid.
What is your personal assessment of the ability for the government, your level of confidence that the government can actually make these moves and address this challenge?
Look, the current government has been very, very slow in policy reforms over the last 5 years. We expected the current president, when he came into the presidency, to accelerate reforms. Unfortunately, we've not seen that. The reforms on power generation side have been slow, but we think sufficient now to attract the domestic investment, in fact, some international investment as well. But the restructure of Eskom itself, the correction of Eskom, needs to be accelerated. Splitting Eskom into its 3 parts needs to be accelerated as well. Unfortunately, we've got a general election next year, so significant policy changes are going to be difficult. So our baseline expectation is that we're not going to see massive policy shifts, which we need. We need the structural reform to attract the international investment. I don't think anything's going to happen until after the elections next year.
Okay, and I want to get on that. Before I do, Richard, what is your sense when you speak to those international investors as to their view on South Africa? Is it becoming crystallized in terms of their negative response to the lack of appropriate policy action in South Africa, the concerns, the challenges, or is this a short-term concern for those investors?
Look, I do think it's relatively short-term. South Africa does have a lot of positive attributes that can attract international capital for an emerging market. We have a very sophisticated financial sector, for example, a well-established legal system, strong and deep capital markets. So all those things that the private sector needs to have in place are here. And that's not going to go away. So that kind of infrastructure, financial infrastructure, regulatory infrastructure is all in place to attract the capital, both domestic and international. However, you can imagine with the amount of load shedding, and I see our minister, our newly appointed Minister of Energy, has said that we could be expecting load shedding stage 8 to 10. Apparently, he referred to that in a speech yesterday. That is very, very negative for us. So until we get the load shedding and the energy crisis sorted out, we're not expecting a significant inflow of capital, as you can well imagine.
Okay. And presumably that load shedding question and issue will be front and centre when it comes to those elections next year that you flagged, the national elections in South Africa. What is the political risk there, do you think, Richard? How do you see that unfolding?
Look, I think there's probably the highest level of uncertainty politically that we've had since 1994. There's a lot of speculation that the ANC will lose its control at 50% and could go below 50%. There's a lot of uncertainty and speculation around who they will go into alliance with. When we look at the domestic side on local authorities, it does appear that they are siding in certain instances with the EFF. That will be very negative for international investors and domestic investors. So I think the level of uncertainty on the politics will, again, make it very difficult to currently attract a significant investment, both internationally and domestically.
And Richard, if we step back from the uncertainty and the challenges in South Africa, and and look at the uncertainties in the global banking space, particularly, of course, in the US in recent weeks and months, and of course, UBS, Credit Suisse in Europe. What is your assessment of where we stand in terms of that banking crisis? Are you confident that we're through the worst of it?
Yes, I am confident we're through the worst of it. I don't know even personally if I would refer to it as a banking crisis. You know, we've had 2 banks in the US. Yes, I know some of the larger banks have stepped in to assist in First Republic. There's certainly not been a spillover here into South Africa. Our domestic banking system is very highly regarded and well capitalized. I think when I look across into Europe, the Credit Suisse situation was pretty well known. I think it had been in a gradual decline for 3 years. I think it all seemed to happen at the same time. So I wouldn't call it a global banking crisis as such. We are obviously very, very acutely aware of the spillover and systemic impact that runs on banks can have. Having read the press recently and referred to some of the comments made by the CEO of Citibank and others around how this could be with digitization of banks and the ability of depositors to withdraw money digitally and electronically, does make the system slightly different to what it perhaps was in the past. But from my sense is that the regulators are pretty much on top of what's happening. I think the large systemic banks seem to be well capitalized, in good shape, and their stress scenarios that the regulators have done, I think, are probably appropriate.
Okay, Richard Wainwright, CEO of Investec Bank South Africa. Really appreciate your insights on the broader global banking space, the challenges, the hurdles, of course, facing investors in South Africa, and of course, particularly around the energy crisis and political risk. Really appreciate those insights. Right, coming up later today, we're going to be at the IMF World Bank Spring Meetings. We're going to be joined by the Reserve Bank Governor of South Africa, so the conversations around that economy continue. That interview is at 6:40 p.m. UK time. Meanwhile, a line crossing the terminal, the Swiss upper house voting for tweaked UBS guarantees. We know that yesterday the lower house voted against those guarantees, largely, as our team have been describing, symbolic. But we keep across these lines for you in terms of the political reaction to that UBS Credit Suisse mega tie-up. Coming up, President Biden has touched down in Belfast as he kicks off his tour to mark the 25th anniversary of the Good Friday Agreement. What are the key things to watch? We'll discuss that next. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in focus today on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, President Biden's trip to Ireland and Northern Ireland begins today. His first stop will be in Belfast, where he will be meeting with UK Prime Minister Rishi Sunak. After that, he'll be heading to the Republic of Ireland to visit Dublin and the counties of his ancestors. For more, let's bring in Bloomberg's Dublin Bureau Chief, Morwenna Coniam. Morwenna, what is on Biden's schedule today and later this week? What are you and the team going to be watching for?
Well, yes, this morning he is in Belfast. He's going to be meeting with UK Prime Minister Rishi Sunak. Then he's going to be actually meeting with some of the party leaders of the Northern Irish parties very briefly before he addresses an audience at the University of Ulster, where there's hoping there will be some discussion of trade in Northern Ireland, as well as really delivering the message about supporting the achievements of the Good Friday Agreement, which ended 30 years of sectarian violence 25 years ago, and also his commitment to supporting continuing peace on the island of Ireland. And that leads up to his trip. He's arriving in Dublin this afternoon. He's then going to be visiting the counties of Louth, and he's going up to Dundalk, where he has ancestry. He'll be doing a bit of a walkabout there before returning to Dublin tonight. And then tomorrow is really the big day here, where he will be meeting with Irish Prime Minister, or Taoiseach, Leo Varadkar. They'll be discussing shared matters of economic interest, the war in Ukraine, and of course, Northern Ireland as well. And then he'll also be addressing the Irish Parliament later in the day. And on Friday, he's heading to County Mayo, where he has a lot of ancestry, and he will be delivering a big speech there on Friday night as well.
Morwenna, do we expect anything substantial, anything concrete on the policy front from Biden?
I think it will be difficult to know exactly what they're going to discuss. There are obviously a lot of issues up in the air, not least we've recently had the revelation that information is being leaked from Pentagon papers, so that is something that's likely to be on the agenda as he discusses matters with his allies. In terms of US policy, it comes down to the economic collaboration, Ukraine, and bilateral agreements, but I don't think we're expecting any major policy announcements directly.
Okay, Morwenna Coniam, Bloomberg's Dublin Bureau Chief, thank you. Ahead of that visit by the US President to the island of Ireland. Coming up later today, we're going to be at the IMF World Bank spring meetings. We're going to be speaking to UK Chancellor Jeremy Hunt. That's at 9:40 p.m. UK time, 4:40 p.m. in New York. We'll be covering all things UK every week, of course, on Thursdays at 9:30 a.m. London time in our half-hour special. Let's get to the Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. Elon Musk says that most of the advertisers who fled Twitter after he bought the company have now returned. Musk spoke in a rambling Twitter Spaces interview with the BBC that actually attracted more than 3 million listeners. The Twitter and Tesla boss also turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. Now, for the first time since 2018, Boeing has taken the jet delivery crown from arch-rival Airbus. The US company says it delivered 130 aircraft in the first quarter, up more than a third from a year ago. Boeing continued to build on its cash cow 737s at a steady pace and released already built 787 Dreamliners and MAX jets from storage. Airbus delivered 127 planes over the quarter. Now, that was fewer than a year ago. EY has scrapped its planned breakup, exposing the shortcomings of the partnership model in professional services. The Big Four accounting firm intended to spin off its consultancy business and much of its tax practice into a standalone public company. Leaders of the $45 billion firm told partners yesterday that an eventual split was indeed possible, but that more time and investment was necessary to make that happen. And a pair of Michael Jordan's trainers from his famous Last Dance season has sold for $2.2 million at a Sotheby's auction. That makes them the most expensive sneakers known to have sold, exceeding the previous record of $1.8 million for a pair of Nike Air Yeezy shoes. Jordan wore them during Game 2 of the 1998 NBA Finals. And coming up, we've got the countdown to US CPI data for March. That's due out later today. And what it could mean for the Fed next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
It's facing the highest inflation in the European Union at around 25% year on year. And Hungary also has the highest effective central bank policy rate in the bloc at 18%. The government in Budapest has been calling for interest rate cuts to try to stimulate an economy already in recession. But monetary policymakers have been pushing back, citing the need to tackle inflation. The challenges are political and geopolitical as well as economic. The Central European country depends on energy imports from Russia and is facing a high bill. That's amid a dramatic weakening of the country's currency, the forint, last year. There's also the issue of EU funding. Prime Minister Viktor Orban's government is in talks with the EU to try to access 37 billion euros of funds. Those are currently frozen over alleged violations of the EU's fundamental rights and perceived politicization of the court system. But in the meantime, policymakers are left with a tricky tug of war as the next policy decision looms later this month on April 25th.
That was Bloomberg's Max Ramsey, and we did get Hungary's inflation data for March earlier this morning. It eased slightly from February, but still came in hotter than economists were expecting at 25.2%. That's year on year. Now, we are, of course, counting down to US CPI data for March, due out later today. Let's bring in Jamie Rush then from Bloomberg Economics on what to expect. Jamie, what are you watching for?
Well, we're expecting, like the rest of the street, that inflation is going to drop to 5.1% on the headline measure. I think probably more important is the core inflation reading, and there I think the news is less good, rising slightly to 5.6% year over year. It's not what the Fed wants to see. Clearly, they're going to have a hiking bias until they see those numbers start to edge down.
When it comes to the euro area, you made the call, or at least one of our guests, I should say, made the call earlier on the programme, getting the two of you muddled up, that actually the inflation picture out of Europe is worse than that in the US. Is that a view you align with?
No, I don't agree. So I think core inflation is going to look bad over the next few months. There are statistical reasons why that's the case. It's not necessarily something genuine. But we are going to see core inflation, headline inflation falling sharply through the second half of the year. So I don't think we have a serious problem. We don't have massive wage gains like we've seen in the US and even in the UK. So I think the ECB's problem is actually faces less of a trade-off than, say, the Fed or the Bank of England.
How many more hikes are you expecting from the ECB then, given that?
Well, I think they're going to be forced to do something over the next two meetings, I think. So another 25 basis points in May and June. At that point, they'll also probably accelerate the pace of quantitative tightening, and that would be a natural point, I think, to take a pause. Risk is they just keep going until September and they actually see core inflation drop.
I'm bringing you back to the Fed because you have this divergence then you're expecting between the ECB and the Fed. You think they go again, the Fed, in May, and then they pause. But the markets continue to bet on cuts towards the end of this year. They're setting themselves up for a fall.
Yes, our US team's of the view that core inflation is just going to be very sticky. Even if you see growth start to even turn negative in the second half of the year, it's not going to make a dent in underlying cost pressure until later on. So we don't have any cuts from the Fed in our forecast until early 2024. I guess the wild card is financial stability. If things flare up again, that could bring things closer.
On the headline basis, there's a temptation to put it to one side because of that focus on core, because of that focus on services. But the headline is important in terms of psychology, the psychology of the consumer. Have consumers started to walk away from expectations that inflation will remain stubbornly high? Are we starting to see the consumer change on that?
I mean, we haven't seen it too much in the US yet. I mean, I think 1 and 3 year ahead inflation expectations are still pretty high. But you're right, though. I mean, the reason that central banks were so attuned to the headline rate when this all started is because they're worried about the risk to inflation expectations that headline inflation causes. That, at least, is going to go away over the coming 6 months. So, I mean, there's small mercies there.
OK, small mercies. We're looking for those small mercies. Jamie Rush bringing them to us live on Bloomberg, of course. Thank you from our Bloomberg Economics team with a preview of US CPI, all important for markets today, of course. Bloomberg Surveillance Early Edition continues in the next hour. None other than Matt Miller in New York and Anna Edwards in London. We check in on the markets. European equities gaining 0.2%. Futures in the US now turning higher by about 0.1%. Range bound on the NASDAQ futures. The US 2-year remains above 4%. This is Bloomberg.
built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Hopes that they can continue to hike rates while also supporting the financial system through their tools for financial stability, which includes macro-pru, regulation, supervision.
They still want to be sure that inflation is moving lower in a sustained fashion.
We don't know exactly how long it's going to take for all that monetary tightening they did last year to work its way into the economy. The Fed shouldn't just be on autopilot and keep hiking.
This is not going to be the immaculate deflation story that we had at the very start of Q1.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Fed versus inflation. Officials at the central bank are signaling a divide over whether to raise interest rates again. We will get the latest numbers on consumer prices in a few hours' time. The big banks that shored up First Republic last month are now planning to bolster their own reserves. The largest contributors to the $30 billion in deposits are putting aside $100 million each. And multi-billion-dollar offers on the table in the commodities sector. Both Newmont and Glencore are hoping to close deals. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, we are waiting for that inflation print once again. I know that you are excited.
I am pumped up, yes, because look, yesterday we had one of the most boring days just looking at the indexes that we've had in months, right? We were trading on the S&P 500 in just a 0.5% band. That's the littlest movement that we've seen since November in the benchmark index. However, on CPI days over the past year, we've seen the S&P move up or down an average of 1.9%. That's a pretty big move and more than double what it had been in the previous 12 months. So wait for the number coming out at 8:30 a.m. New York time, and then just watch the markets. Right now, we're just up 0.1% on futures, but I'm pretty excited for this release, as I think is everyone else. Take a look at the lack of movement everywhere else, right? I could have picked any assets, but the 10-year yield still at 343, 344. NYMEX crude still at $81 a barrel, 81.65 right now. Bitcoin still at 30,000. Gold still at 2,000. Everything is just stuck here, I guess, waiting for CPI or waiting for Godot. I don't think I ever saw that play. Let's take a look at what's going on in Asia. Right now, the MSCI Asia Pacific is completely unchanged. The Hang Seng down, the Nikkei up, and the dollar gaining a little bit of ground against the yen. Really just in wait and watch mode. Anna, what's Europe looking like?
Yeah, absolutely. Wait and watch mode. That's certainly how things feel here in Europe. Really not moving anywhere very fast. We still have plenty to talk about in terms of those big global themes, but the market's not really reflecting that sort of narrative excitement today. We're up by 0.6% on the FTSE 100, which is more than we were half an hour ago. But certainly we are seeing modest gains across Europe as we wait for that print. The IBEX down in Spain, catching up from some of the losses that we saw this time yesterday on the Spanish market. Technology in focus. That's one of the sectors that maybe underperforms a little bit today. Prosus, it has a stake in Tencent over in Asia, and they've been reducing their stake gradually in that business. That's weighed on Tencent. There's been speculation maybe Prosus will start selling the stake a little more quickly. That's quite a heavy weight in the Dutch market, and that weighs on the technology sector. Volvo is up by 7.7%. This is not the cars, this is the truck and the bus manufacturer, up by this amount, 7.7% as a result of the numbers coming, right, there we go, as a result of thank you very much for translating into English. As a result of the better than expected numbers coming through from Volvo early hours, well, last night. So that's certainly one that we're watching. Supply chain issues, seemingly a thing of 2020 and 2021 and not of 2023. Here's a couple of currencies. I put the euro dollar in here because we're watching that with CPI in focus. I also put in the Hungarian forint. It is one of those days where we cast our eyes a little further for some of the assets that may or may not be moving, and not a great deal of movement in this, despite the fact that we've got a really interesting inflation story here, coming in above 25% for the Hungarian economy, the highest in the European Union, rates the highest in the European Union, but we have seen for the second month a little bit of moderation. It seems maybe this cross also waiting for the CPI print.
A little bit of moderation, but I know you spoke with Wei Li this morning from BlackRock. They expect inflation to be sticky. The ECB expects inflation to be sticky, so there's real concern about prices once again. Speaking of that, Fed officials are signaling there's a divide over whether to raise rates again. New York Fed President John Williams says there's still more work to do to bring down inflation, but Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now.
Today, what I want us to think about is why I think that at moments of financial stress like this, the right monetary policy is really caution and watchfulness and prudence.
Valerie Teitel, Bloomberg Markets reporter, joins us now for more on this. So Fed officials have spoken publicly in the past couple of weeks, sounding pretty similar in their message, but now we have a new guy, not really new, right? He ran the Council of Economic Advisors under Obama just after the financial crisis, but a new voice, let's say, on the Fed.
Yeah, the new voice, Goolsbee, maybe he'll start sounding a bit more like Brainerd. He very much suggested in his speech yesterday that he wants a Fed pause in May. He said we need to be patient in the assessment of just how much last month's banking turmoil will contribute to tighter lending conditions. Now, that stands in a bit of a contrast to the other Fed members that we've heard from, namely Mester, Bullard, and Williams, who have all said that they have not been swayed yet by the banking crisis when it comes to hiking rates. Williams just yesterday told the press that one more hike is seen as reasonable. And then we also heard from Harker saying he wants to hold rates above 5%. That suggests another hike is coming in the May meeting. Now, they have said also differing things when it comes to credit conditions tightening. Williams 2 days ago said he hadn't seen any clear signs of credit conditions tightening. Well, we got a small business survey out yesterday, and boy, it showed that credit availability to small businesses has contracted in March, and it contracted quite substantially. Compare that level to the levels that we reached during the credit crunch of 2008, 2009, and you can just see how sharp this drop was. Now, you also have to combine this with the survey data we got from consumers on Monday, also painting the same picture that March has saw a big contraction when it comes to credit availability, both for consumers and for small businesses. We do also get those Fed minutes tonight. I'm going to be watching very closely if there is a discussion on what they will weight more in the May meeting. Will it be the survey data on credit conditions, on lending standards, or will it be the harder economic data like the CPI we get today?
Yeah, certainly worth watching then, Valerie. And with that CPI in mind, what are we expecting from today's US CPI print? Really fascinating to see how this has morphed from a story that was about goods and supply chain disruption to one that is almost entirely about, well, food and mostly services.
Yeah, those sticky core services are still keeping the Fed up at night. The CPI, the headline today, is expected to moderate quite substantially from 6% previously to 5.1% today. That's the Bloomberg consensus estimate. A lot of the attention, like you said, is going to be on the core month-on-month number. It's also expected to moderate, but not by much, falling from 0.5% last month to 0.4% today. Now, a lot of the attention, as I said, is going to be even now on the breakdown of those core inflation when it comes to core goods, which we know has been dropping off like a stone in the last 12 months, versus the more sticky component of core services. Remember, Anna, it was only back in February that Powell told us in the press conference that core services was his main worry. Has the Fed hiked enough in order to bring core services back to target? It's a component of inflation that is less sensitive to interest rates, and it makes up a very substantial portion of the CPI basket.
For 5.6 or better. Now, the biggest U.S. banks are planning to bolster reserves in a move tied to their unusual effort to shore up ailing lender First Republic Bank last month. Let's get to Bloomberg finance editor Michael Moore. So what's driving these reserves from the big banks? And we should point out, really not big reserves compared to the amount that they put on deposit.
Yeah, you're talking 2% of the total. But it is a recognition that this is not a riskless asset, you know, that putting this money into First Republic does carry some risk. And, you know, it could be a meaningful move to the quarter's reserves. You know, Bank of America last quarter had $1 billion in total reserves. So adding $100 million there does move the needle to a quarter to quarter. But assuming that this plan works and buys First Republic time to sort itself out, you know, then they wouldn't actually lose anything, and they could take the provisions back. But it is an acknowledgement on the accounting side that there is some risk at play here.
And let's pivot from US banking then, Michael, to European banking, and particularly the case in Switzerland, of course, the ongoing conversations within the Swiss parliament about what just happened with UBS and Credit Suisse. Now, tell us what's happening here, because we've seen some objections being raised in the lower house to the deal, but this is really very symbolic rather than actually standing in the way of the deal being done.
Yeah, it's a bit of a protest vote showing that the lawmakers were not happy with how this was arranged, how it was set up. So there, you could see some tweaks to some of the government guarantees perhaps in the future, or changing the rules. But yeah, it's not a vote on the deal. The deal has been set up and approved by the Finance Council of the government. So it will go ahead, but it is an election year in Switzerland, so you are seeing a bit of discussion over how this was handled.
Maybe a little bit political. Michael, thanks so much. Michael Moore there talking to us about the banking news. Let's get now to M&A, because deal making in mining is heating up. U.S. gold giant Newmont has sweetened its record bid for Australian rival Newcrest. We told you about that yesterday. If successful, it'll be the world's largest gold acquisition. Meanwhile, Swiss commodities giant Glencore is making an effort to buy Canada's tech more appealing. They're trying to help people reduce exposure to coal, dirty coal, if that's what they're worried about. Will Kennedy, Bloomberg senior executive editor for energy and commodities, joins us now. So Will, mining M&A has been pretty quiet for years. Why are we suddenly seeing these big deals?
That's right, Matt. There haven't been many big deals for the last 10 years. Investors have been very cautious about big M&A, but that does seem to be changing right now. I think there are two key drivers. One is copper. Clearly, the pursuit of tech by Glencore is driven by their desire to get their hands on Teck's copper mines. Copper is forecast to be in a substantial deficit in the coming years, and when we interviewed CEO of Glencore, Gary Nagle, last month, he said that he expects copper to go above $10,000 and stay there. So that's the bet he's making. Copper is absolutely crucial to the energy transition and the rise of electrification. The other thing that's going on here is that people's balance sheets are strong. If you look at Glencore, for example, it's made huge profits over the last year, driven by its coal business, and it has very little debt at all. It's got the capacity to do deals, and it sees this as the right play. And going back to Newmont-Newcrest, copper is also a driver there. It's primarily a gold mining company, as you say, but Newcrest wants half its production to come from copper in coming years. So that's also in the background with the gold deal.
So it sounds from what you're saying then, Will, that you think that there could be more of this, given balance sheets as strong as you point out, and there could be reasons to go about looking for these kinds of assets globally. On the Glencore and Teck Resources deal, Matt was mentioning in the link there that there might be some concerns about certain types of coal being more dirty, and maybe this is going to be something that stands in the way of these deals. They're not all done deals just yet.
No, they're not, and especially the Glencore. That deal is very much in the balance. But what's interesting about it is that it will, if it goes ahead, you will get a metals company and you will get a coal company. And those people who want to stay in coal can stay in coal, and those people who want to be in the metals company can. And the thing that Glencore did yesterday was give people the option to take cash rather than shares in the coal company. So it provides options for people who are happy to be in coal and those more ESG investors who aren't.
And I think that makes it creative and even more interesting. Will, thanks very much for joining us. Will Kennedy there talking us through some of the M&A in mining. Let's take a look at some of the pre-market movers, because M&A stocks plays well into that. Emerson Electric is in advanced talks to acquire National Instruments after the long pursuit of the maker of measurement systems. According to people familiar, you may not have heard of any of these companies, but Emerson Electric is a $60 billion company. National Instruments is a $7 billion company. And Emerson beat out Fortive, so far at least, talking about paying $60 a share for National Instruments. Fortive is a $25 billion company. So these are big companies all competing for National Instruments, which makes hardware and software that scientists use. I think a very interesting M&A story there. Also, Bed Bath & Beyond shares are rising in pre-market trading after the troubled retailer raised almost $50 million for the sale of 100 million shares. It's looking to raise cash to avert bankruptcy, just to keep the lights on, really. And then Carnival, the cruise line, plans to pay down debt to avoid borrowing at these high rates. That, according to the chief financial officer, David Bernstein. The Miami-based business had about $8 billion of liquidity. That's enough to pay off roughly $4.5 billion of debt due coming later this year and in 2024. This, according to an interview that Bernstein had with Bloomberg yesterday. Anna?
Coming up on the program then, Matt, we will talk about flows. We'll speak with Vice President of Spider ETFs at State Street Global Advisors. We'll get the perspective on where money is flowing into and out of right now. That'll be an interesting conversation. What about EM in a world where the US slows down? We'll also talk to Sylvia Ardagna, Chief European Economist at Barclays. She'll be giving us her Europe view, but also the view on CPI and the data due out of the US later and what that means for the Fed. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Anna Edwards over in London. I'm looking at a really interesting chart. For those of you on radio, listening on radio, I'll walk you through it. Basically, it's the gold to oil ratio. It spiked up during the beginning of the pandemic as people freaked out, obviously, and stopped driving.
This is a really good yardstick to just kind of explain how people feel about risk right now. I think what we're seeing is a lot of investors looking for the safest of assets out there because what's coming is economic pain. And I think that seems to be the consensus. It's not just in gold and oil. We're seeing that in the credit world. Today, for instance, we've got about 8 issuers in the market. Almost all of them are selling the safest of the safe bonds, and that's because there's absolutely no appetite out there for risk whatsoever. So that is a really interesting warning sign that my colleague Van Ram has put together.
Okay, so that's an interesting warning sign, Dana. And yesterday we spoke to one of your colleagues around the credit markets, and you've got some other insights. We're learning day by day what investor appetite looks like for different types of credit, of course. Where do we stand in terms of demand for risky loans at this point, and why do we see the dynamics that we do?
So what's really interesting within the risky loan market is because people are seeing an end to the hiking cycle, all of a sudden there is demand out there for risky loans because these are floating rate assets. So there is the financing buyout that was used for DSM, which was basically sold to a bunch of investors that genuinely wanted this stuff, and that's because they think interest rates will likely fall. That is basically a sign that recession might be coming, because the assumption is that if central banks have to worry about the economy, then they're not going to continue hiking rates even though inflation is high.
And that could be good for those businesses looking to raise money right now. Diana, thank you very much. Bloomberg's Dana El-Battaji. For more market analysis on credit markets and much beyond, Markets Live Go is the function to use on your Bloomberg terminal. That's where you'll find the blog. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. President Biden is in Belfast, Northern Ireland, where he'll mark the 25th anniversary of the Good Friday Agreement. That deal ended decades of violence between Catholics and Protestants. The president's also meeting today with the UK Prime Minister Rishi Sunak. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of the author Jean Carroll. His lawyer says a cooling-off period is necessary following his indictment in the case of hush money payments. The trial in the Carroll case is due to start April 25th. Walmart is cutting the number of stores in Chicago in half, from 8 to 4. The nation's largest retailer says it hasn't made money in its 17 years in the city. Walmart faces tough opposition in Chicago from Target, Albertsons, and Aldi. It says that crime and theft, though, were not leading drivers of the decision. And Elon Musk says that most of the advertisers who fled Twitter after he bought the company have returned. Musk spoke in a long Twitter Spaces interview with the BBC that attracted more than 3 million listeners. He also defended firing thousands of workers, and Musk turned the tables on his interviewer, questioning the BBC over hate speech and COVID disinformation. So, interesting? Is it interesting? I guess.
Well, it was a wide-ranging conversation in which, Matt, he announced that Twitter has a new CEO and that CEO is his dog. So there you go. It ranged far and wide. Coming up on the program, we'll talk to Vipul Faujda, who joins us, Vice President of Spider ETFs at State Street Global Advisors. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed versus inflation. Officials at the central bank are signaling a divide over whether to raise interest rates again. We'll get the latest numbers on consumer prices in a few hours' time. The big banks that shored up First Republic last month are now planning to bolster their own reserves. The largest contributors to the $30 billion in deposits are putting aside $100 million each. And multi-billion-dollar offers on the table in the commodities sector. Both Newmont and Glencore are hoping to close deals. I'm Anna Edwards in London with Matt Miller in New York. And Matt, we're really focused on that CPI print due out later today. Interesting what that means for the Fed and the hiking cycle, but also talking to some of our colleagues on the Markets Live blog earlier on, they draw attention to whether we'll get any clues, any softness in inflation. Could that add to bets on rate cuts later on in the year? And maybe that's where some of the excitement could be.
Yeah, I guess we'll be turning to Warp right after we look at EcoGo. Right now, we're not seeing a heck of a lot of movement in markets as investors sit on their hands waiting for that print coming out at 8:30 a.m. Wall Street time. S&P futures are up about 0.1%. You have seen a ton of volatility around CPI prints over the past year. In fact, the S&P 500 has moved up or down an average of 1.9%, which is more than double what it's done in the previous year. You could see less of that. Futures and options are pointing to less of a volatile reaction today, but still very important to watch the print. The U.S. 10-year yield, very little change right now at 343. In fact, all assets are going to be very little change because everything is affected by this, or most everything, and as a result, traders want to wait, sometimes even turn off the algorithms and watch and go through the print with human eyes before making moves. You can see NYMEX crude still at $81 at $81.74 right now, and Bitcoin holding right at $30,000. Gold is holding right at $2,000 as well. So you don't see, even in the dollar, really very much movement. Take a look at some of the movers this morning you talk about, and we're going to talk about the commodities M&A. There's also some M&A going on, really a takeover battle for National Instruments. It's a $7 billion company that makes hardware and software scientists use to measure things. Emerson Electric has made a $60 a share offer, and that could be the winner. We'll watch for that. Bed Bath & Beyond has raised $50 million, almost $48.5 million through the sale of 100 million shares. It's looking to avoid bankruptcy. It's obviously a penny stock, so we see very little movement in the pre-market that results in bigger percentage moves, but we'll watch that at the open nonetheless. Carnival Corp, I think, is very interesting. This is a cruise line whose CFO gave an interview to Bloomberg yesterday, and he said They're not interested in buying or in issuing debt right now at these high rates, but they are paying debt down right now, and we're going to watch for any reaction to the shares. Not moving much right now. I'll talk about this later with my colleague Paul Sweeney on Bloomberg Radio. He's obsessed with the cruise lines. And then Nutex Health right now up 30%. It has entered into a $100 million prepaid advance agreement with Yorkville Advisors, and it's also a small stock. So as a result, that produces a very big move in percentage terms. Anna, what do you see in Europe?
Yeah, we don't see big moves here in Europe, not at the aggregate level, at least, Matt. We are waiting and waiting for the CPI print out of the US. It's a quiet day besides that. We're up by 0.2% on the Stocks Europe 600. So modest gains being made here this Wednesday morning. Volvo is one stock that really outperforms. This is the truck and bus manufacturer based in Sweden. They have reported numbers that were better than expected. It does seem as if some of the issues around supply chains are in the rearview mirror. Maybe we saw that in the China PPI data we got out earlier on this month. We also see it perhaps in the CPI print later on from the US, the way that this is not about goods anymore. This is about services. And so the supply chain issues that had been such a problem for that sector, perhaps in the rearview mirror now. And here are a couple of FX crosses just to watch as we get that CPI print later on today. One of our colleagues on the Markets Live team talking about the carry available in Hungary right now, given we've seen such high levels of inflation, above 25%. Yes, we've seen a little moderation there, but still the concern is about these incredibly eye-watering high levels of inflation in Europe. As a result, we have high interest rates, of course, over in Hungary too, and we got that inflation data earlier on today. And the euro is fairly flat, really, with a 109 handle, clawing its way back to 109 from that little wobble we saw around the financial services tension, shall we call it. 109.22 for the euro against the US dollar as we wait for CPI, Matt.
Yes, we are waiting. Joining us now to help us wait and watch is Vipul Faljar, SPDR Spider ETFs Vice President at State Street Global, really the behemoth, the first, the original, the OG ETF. Vipul, thanks so much for joining us. What do you see in the flows right now? I mean, there's such uncertainty as we near what we think is the peak of the hiking cycle. How do you see this playing out in ETFs?
Matt, firstly, thanks very much for the very kind intro. So in terms of flows, yeah, it's been a very, very strong start to the year. ETFs in Europe have already seen 45 billion go in. About half of that has been in equities and about a third in fixed income. The real kind of surprise has been EM. I mean, EM has seen flows in Jan, Feb, and March, and has taken 50% of all equity ETF flows year to date. So a really strong start to the EM space, obviously triggered by that China reopening.
Yeah, so China, a big part of that. Good to see you, Vipul. But talking about the resilience of that EM trade, I suppose is interesting. I was talking to a guest from BlackRock earlier who was also talking positively about EM, but suggesting that this would stand up in the face of a mild recession in the US, but not something more drastic. And I guess that's where we could see the EM trade diverge later in the year.
Yeah, that's right. I mean, the EM trade is always seen as a bit more of a risk-on trade. Of course, we've seen China do very well in Jan. I think the EM trade has underperformed a bit after that, and focus has shifted to other regions like Europe over US, etc. So I think it's one to keep an eye out. I think in the longer run, we do still like EM, and the growth that's going to come out versus developed markets will be from the emerging market space, we predict.
Okay, so something to watch there. In terms of the sectors that you see flows into, I mean, financials had an incredible start to the year. Europe, as a result, had an incredible start to the year. Then March happened and things did not look so good. So have we managed to normalize a little bit, or at least go back to that positivity of earlier in 2023 since the sort of really tough times of March?
I think it's still really early days for the financials, given that it's all fresh in the head what's happened with Credit Suisse and SVB. Financials, surprisingly, have still seen the most sector ETF inflows year to date. March wasn't the case. March, they were pretty much flat. And actually, those sector ETF inflows have turned to sectors like technology. We still think financials are worth keeping on the radar, but it may be a bit too early to go back in, and we'll just let the dust settle a little bit, see what the capital buffers come in, see what the regulators say.
You've seen a ton of money go into money markets, from deposits, obviously, into short duration ETFs, short duration treasuries ETFs from deposits. Is that starting to turn around a little bit? Are you seeing a little bit of a reversal of that trade?
Yeah, so it's really interesting, Matt. Last year was really a kind of treasury year, sovereigns, and then we kicked off this year with corporate debt. Last month, again, it went back to kind of sovereigns and that slight flight for safety given what happened with the banking volatility. But overall, what we quite like is that short duration investment grade credit part of the curve. Reason being, for example, in the UK, you get about 5.5% to 6% yield in kind of broad UK credit. And then if you've got a short duration of kind of 2.5 years, we think the risk reward there is pretty solid.
One of the other big moves that we've seen in the ETF space, you know, over a longer period of time has been the conversion from mutual funds into ETFs. How much more do we expect to see that? I mean, right now, I think globally, the ETF market is about $10 trillion, I should say. How much can that grow?
So time and time again, Matt, when we speak to investors, they just really appreciate the fact with the ETF space, you can get that real timely activity in, and you don't have to obviously wait when it comes to the mutual funds in terms of kind of putting your trade orders in. And I think in this kind of generation of kind of instant and very time-sensitive activity, ETFs can only grow in terms of that activity. And we're seeing more and more of those kind of conversions happen.
Okay, and then back to the story sort of flows within ETFs and what you're seeing. We're heading towards earnings season, and there's a lot of focus on whether we get to an earnings recession, the amount of pricing power that companies have right now. How do you see investors positioning ahead of yet another earnings season?
Yeah, and I mean, look, last quarter was pretty tough in terms of earnings beats. You know, they were the lowest, I believe, since sort of the start of COVID. Again, we're going to head into a kind of downbeat kind of earnings segment here. I think we're predicting 6.3% down. In terms of how investors are positioning, I mentioned last month the biggest inflows were into the technology sector. Funnily enough, they're seeing technology as more of a defensive sector at the moment, because if we do see a situation where the Fed tends to cut rates even more aggressively, of course, that's where the tech sector will come in a bit more in terms of its performance, like we've seen here today.
And a lot, as you say, a lot riding on where the Fed goes in 2023 and into 24. Where do you stand? I've been waiting for the CPI data today. It's the big data point of the week. Where do you see the narrative around whether the Fed cuts later in this year going?
Yeah, it's a big question right now, and all eyes are on the CPI data. So we predict towards the end of the year, we'll see 50 bips worth of cuts. And where we're slightly away from the street is we expect the Fed to pause in May. So I know that people are pricing in a 25 bip rate hike. We think, given what we saw last month with the banking volatility, that's done a bit of the Fed's work. So it's time for, in our sort of opinion, for the Fed to pause and then wait to see towards the end of the year where we get about 50 bips worth of cuts in December.
Okay, Vipul, thanks very much. Thanks for joining us. Good to speak to you. Vipul Faujda of State Street Global Advisors. Coming up on the program, we'll get another view on CPI and the Fed. Sylvia Ardania joins us, Chief European Economist at Barclays. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, investors are counting down to today's US CPI data, which is expected to show inflation eased for the 9th straight month. Goldman sees stocks dropping at least 2% if the year-over-year rate comes in above the previous reading of 6%. Joining us now is Silvia Ardagna, Chief European Economist at Barclays. Silvia, very nice to speak to you. We'll get to Europe in just a moment, but focusing in on the big data points of the day, of the week, and that is US CPI, of course. You expect, I think, like the street, 5.1% on headline year-on-year inflation. What are you going to be watching out for? There's a lot of focus on the super core, on services. What holds the key for you for inflation?
Hi, Hannah. Good morning, and thanks for having me here. Yes, the key for us is really the components of this print. We are expecting core inflation at 5.6, with the month-on-month print at 0.4%, so slightly below what we get last month. And we will look for goods inflation to remain on the firm side, but service inflation to begin to moderate. And that's, if it happens, it's a good news and a welcome development, because service is clearly key for this inflationary process to be on a more steady pace.
It's really quite incredible when you look at the development of the components of inflation. I mean, we're talking about the US here, but to some degree this applies elsewhere. The way that this was very much a supply chain and goods story a couple of years ago, and really now it is not, is it? It's almost all in services, food as well, but services very much the heart of this. That's labor costs as well coming through there, I suppose.
Yes, there is some, but I would say that across the world there is a difference in the various jurisdictions. Clearly, labor costs have gone up much more in the US, in the UK, than in the euro area. In the euro area, wage growth has remained still at levels that are, we would say, consistent with the ECB inflation target of 2%, and we really don't see any wage price spiral. And indeed, in the euro area, when we look at the components, the core goods inflation has remained more stubbornly high than the service.
It does seem like we're hearing from more and more people, Silvia, that this inflation, whether we're talking about U.S. inflation from the view of BlackRock, and I was speaking with Wei Li on Bloomberg Radio this morning, or European inflation from the view of the ECB, it's going to be sticky. We're going to be sitting with this inflation for years. Do you share that view?
I mean, we share the view that it's going to be sticky, in the sense that it will take a few more months before it goes down more significantly, particularly in the euro area. But we don't agree with the statement that we are going to live with it for years. I mean, in our own forecast for the euro area, we have inflation going down to 2% at the end of next year. And we really think that the central banks are committed to bring it down to 2%. So in our forecast, we see even core that is going to remain elevated above 2, continuing to decline and decline toward the central bank's objectives.
What kind of recession does the Fed need to put us into to get inflation down to 2%? Because the concern here is that, even a couple of non-systemically important banks facing runs made the Fed rethink their rate-raising path. So if you have real problems, they're not going to have the resolve.
Well, in our forecast, we have a recession in the U.S. economy that starts with a negative GDP print in Q3 and lasts until Q1. But by historical standard, it's quite a moderate recession with some increase in unemployment, but again, still at very low levels. And we think that the Fed will hike one more at the May meeting, and then it will leave the federal funds rate at 5.25 range for a significant period of time, I would say more than what the market expects. We have the Fed on hold until the beginning of next year, and that, in our view, is sufficient to generate the slowdown in economic activity that is needed for inflation to come down to 2.
What do you think, Silvia, would need to happen for the Fed to cut? So you've set out your path ahead, one more hike maybe in May, and then a pause until the start of next year. One of my colleagues on the Markets Live team was talking earlier on about how he thinks we need to see real yields in positive territory, a number of different measures of that, of course, but for him, that needs to gain sort of more ground before we'll start to see the Fed cutting. That's not necessarily their mandate, but that's what he's looking for in market terms. What are you watching for to allow the Fed to sort of make that move to cutting? cutting?
I mean, we have the Fed beginning to cut when indeed we see inflation coming down, quite significantly, and we see the unemployment rate beginning to move up. Because if the Fed were not to cut, then policy would be so much restrictive that we would risk having too much of a deep recession and inflation going down, way below where it should be in the medium term. So we would agree with the view that, again, if the Fed were not to cut, real rates will become way too positive. And again, you can measure them depending on different metrics of inflation. But if you take the one-year inflation based on our forecast, we would have, that the Fed would need to cut at the beginning of next year.
Sylvia, can I ask you about the availability of credit? I've heard a few statistics in recent days, both survey data and also loan data that give me pause. Are we facing a credit crunch? Is the availability of credit in danger right now?
We did a very, I would say, deep analysis of the transmission channel of monetary policy through the credit market and the real economy. And I would say that what stands out is the fact that monetary policy is working. We see that financial variables, including all the credit data, are responding to monetary tightening. So we have a slowdown in credit creation from hard and survey data, both in the US and in the euro area. Now, whether you want to call it a credit crunch, perhaps it's, it depends on your definition. In our world, what the credit decline that we are going to see is what is sufficient, right, to what is, first, it's a byproduct of the monetary policy tightening that is needed to cool down inflation. And second, part of it will be also generated by what we have seen in financial market recently. Clearly, banks' officers are going to be more risk adverse, and they are going to tighten lending standards more than they would have had if there was no turmoil in financial markets. So for us, the turmoil is worth everything between 1 and 2 hikes, in the US and in the euro area that we have removed from our baseline forecast because the credit crunch is coming endogenously from the financial market development.
Sylvia, thank you very much. Really interesting detail there on the provision of credit then in various global economies. Sylvia Ardagna of Barclays joining us to talk about the CPI print ahead and much more. I just want to flag something that's happening right now that we are monitoring. The CEO of Binance, that's Changpeng Zhao, of course, is speaking in a fireside chat at the Web3 Festival in Hong Kong. We'll continue to monitor his remarks, bring you any headlines that are generated from that conversation. You can watch the event on Live Go on the Bloomberg terminal. This is Bloomberg.
About the security and they trust the platform. I think the next question is, I take exchange, for example. Exchange is one of the gateways to get people into crypto or Web3. And I think it's fair to say.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what's driving the steep rise is a flight to safety. If you look at the correlation of Bitcoin, it's traditionally in the past few years been very correlated to the NASDAQ and to the S&P. We're now seeing it decorrelate from the NASDAQ and S&P and correlate much more to gold. With the banking crisis, many people realize that this is really what Bitcoin was born to do. It was born to be an asset where you control the keys, you hold your money, and nobody else does.
That was Fred Thiel, the CEO of Marathon Digital, a crypto miner, speaking about Bitcoin's recent rally on Bloomberg Crypto yesterday. And right now, the CEO of Binance is speaking in a fireside chat at the Web3 Festival in Hong Kong. You can follow along with that if you want on your Bloomberg terminal. You can just type in Live Go and watch what CZ has to say. Of course, all the more interesting ever since Anna, the CFTC, filed suit against CZ and Binance, saying that they are encouraging or helping clients to get around certain regulations. In terms of Bitcoin and the run-up that we've seen to $30,000, I think it's really interesting that investors are choosing this as really kind of safe haven or a store of value, especially considering the volatility we've seen in Bitcoin in the past. Yeah. I showed at the beginning of the program a chart that measures the gold ratio to oil and how that climbed in March of 2020 and is now climbing back up again. The Bitcoin to oil ratio is very similar, with the exception of a couple of stimmy spikes that we see during the pandemic. So I think it's fascinating that investors really are taking to this asset.
Yeah, it is. I mean, how much of it is about the sort of anything but fiat arguments that maybe have been given a boost in the views of some by what we've seen in financial services in recent months, and how much of it is just a play on the Fed and more people expecting cuts from the Fed, and so there could be that cyclical element to it. But regulation has got to be something that hangs over the sector, Matt, as you alluded to.
Yeah, I think regulation very much does. In fact, we heard from Fred Thiel yesterday that in his view, the U.S. is trying to put an end to crypto mining and the crypto industry in the U.S., and so they're looking at other places to do business. But, you know, the idea that the Fed is done cutting rates and they may come down, that helps to boost Bitcoin. That's also helping to boost gold. So I think it's very interesting, the similarities there.
That's it for Early Edition. Surveillance is up ahead. They will be hearing from Tim Adams, President and CEO of the Institute of International Finance. They'll keep you across all of the Washington developments from the IMF, of course, as well. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The banking crisis has been contained, given that there's good access to liquidity in the strongest banks.
Unfortunately, there's more downside in the equity markets than there is upside today.
You need people to stop spending, you need credit to contract, and that's what slows the economy and brings down inflation.
The Fed wants to hike probably once, maybe twice more, but it's really torn because it's got these obvious troubles.
I think the landing could be quite a bit harder than many are discussing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning, good morning. Down in Washington, D.C. for the World Bank IMF spring meetings with Tom Keene, Lisa Abramowitz and Jonathan Farrow. Equity futures on the S&P 500 just about positive by 0.2%. TK a little bit later this morning. In around about 2 hours and 30 minutes, CPI in America.
CPI is more important than the IMF meetings. I thought yesterday was the strongest Tuesday we've ever had at these IMF spring meetings, and we go right into the theater at 8:30. And what I noticed yesterday is the markets have come to a stop. The volume, I never talk about volume, I don't believe in volume, but the fact is the volume is next to nothing as we await 8:30
Would you
this
like
morning.
to explain why you don't believe in volume?
There's been a lot of research done on this, most of it out of Vanderbilt, of all places. I would have never guessed it, but volume you can make missed calls with volume, particularly on the short side.
I'm not sure why I started this conversation, Lisa, and asked him why he doesn't believe in volume. Probably not the best way to start this conversation. Lisa, I have to say, the IMF and the commentary from the International Monetary Fund in the last 24 hours, the last couple of days, really, really gloomy relative to what we're hearing from, say, Secretary Yellen.
Growth is going to be really suppressed, and the bank stress is going to cause a real issue for the banking sector, but also for the larger economy. So how do we view Yellen's comments, given the fact that she said, actually, I don't view the banking stress as ongoing. I think it's been resolved, and everything is moving along just fine. Is she discredited as just a political actor, or does she become someone who really is the pull to offset what we're hearing from the IMF, and frankly, it's even Fed officials who are using this as an excuse for possibly not hiking as much?
Well, let's talk about the excuse for Fed officials. Goolsbee of the Chicago Fed. Tom, out with a speech yesterday. Actually, really, really great read, I have to say, just reading through that a couple of times yesterday evening. Patience, prudence, the approach from him.
I think this is an economist people don't know. They associate him with the White House. They associate him with political economics, and he's a frontline economist. He's been underestimated since time began. Out of Chicago, but less with a rigorous Chicago tradition. I think more of Gary Becker, the late giant Gary Becker, on his social economics that he dovetails into rigorous mathematics. It was quite a speech.
CPI coming up a little bit later this morning. We'll count you down to that. Going into it, here's a snapshot of the price action for you. Starting with the S&P 500. Equity futures here positive by 0.2%. It yields a little bit higher on a 10-year by a couple of basis points. 3.45 on a 10-year yield. And the euro stronger again, just about, Lisa, here. Euro dollar 109.28. We're positive there by a little more than 0.1%.
It is CPI Wednesday, in case you didn't know, in case you hadn't heard John mention it a couple times today, 8:30 a.m. Eastern. What I'm looking at here is core. I'm not looking at the headline year over year. It is noisy. It'll be made noisier still based on what we're expecting from oil prices, which went down substantially but have since rebounded quite a bit. I'm curious whether we get a big market response to an upside surprise in core CPI. There was a report out of Goldman Sachs saying that you could see a 2% decline in the S&P if you get some sort of, 6% surprise upward. I'm not sure what you could potentially see with that. 10 a.m., the Bank of Canada. I always watch the Bank of Canada rate decisions. I know that other people say, it's not a big deal. But they've been a front rider here, and they basically may hold at 4.5% for a second straight decision, even though economic data has surprised to the upside. How do we see this read through in the yield space? The two-year yield has seemed to have peaked out, but what about longer-term yields? Do we see them pop upward with the fear of inflation getting more concerning? And at 2 p.m., we get the FOMC meeting minutes. Normally, they're pretty dry. This time, we get a sense of how important bank stress was in their discussions, even as they raised rates. We also hear from Tom Barkman of the Richmond Fed and Mary Daly of San Francisco, John.
And whether anyone wanted a pause.
Right, exactly. Basically, we find out underneath the mechanics of this decision and how much dissent there was as Goolsbee really pushed out there this feeling. This is concerning. This could potentially create real stress.
Do I get an IMF freebie pass so I don't have to read the minutes today because I'm overwhelmed with my work at the spring meetings of the IMF?
Well, there's the IMF and the IIF, and we do hear from Andrew Bailey of the Bank of England. He is going to be speaking today, and there's a whole host of other discussions. We will be parsing through them throughout the day.
Governor Bailey's listening to?
Who's that?
Ibrahim Rabari.
Of course he is. That's who's with us now. Ibrahim Rabari, the global head of FX analysis over at Citi. Ibrahim, good morning to you, and welcome to Washington.
Well, it's great to be with you in the studio in the flesh.
Let's talk about CPI, 8:30 Eastern time. What are you looking for a little bit later?
So in general, we think that the risks are to the upside once again for this CPI print. So our colleagues in economics are seeing core CPI at 0.5 core, but with upside risks, where a lot of the upside risks, as you said, are maybe in some of the smaller categories. Used cars probably pop up quite sharply. But what policymakers have been watching closely is what's most closely related to shelter. So core services, most closely related to wages, I should have said. Core services ex shelter. But what I think is important in this reading is how the Fed will interpret it, because the way we look at the Fed at the moment is they're probably going to take any excuse to be more patient or more prudent, as Goolsbee said. So we think a modest upside surprise could probably be shrugged off, both by markets and by policymakers.
President Goolsbee also talked about the data elsewhere, not just the traditional indicators, CPI, payrolls, GDP. We need to talk about bank lending data, what's happening in the banking system. Is that a reason for them to pause, to have that patience, to wait?
So I think there are many reasons at this point to pause. And I think going back, it's simply reflecting that we've had the fastest tightening cycle possibly in history, that many of the effects are yet to seep in. What we like to highlight is if you look at the mortgage market in the US, maybe 10-20% of the rise in Fed policy rates has now seeped into actual mortgage rates that households are paying. So even away from the banking stresses, we think now would be a very good time to pause and reassess. There are big nonlinear risks out there. But of course, the banking situation is creating a new layer to these uncertainties. So the Fed certainly will be looking at that with great attention. The data we got from the Federal Reserve Bank of Dallas recently pointed to some signs of I think, at least unease about lending. But we think even when it comes to the lending data, we probably will only know over the next 6 months or so how these conditions will evolve. So lots of reasons to be prudent and patient.
But taking a step back, just to sort of give a sense of how the Fed is weighting these two issues, what's more important, today's CPI print or what we get from JP Morgan on Friday?
Well, it's a very good question, and I think if you ask the Fed, they have to say it's about inflation, and they're not yet at a point where they're comfortable with the trajectory, let alone the level of inflation. But I do think that when you're an investor, you have to take a step back from the spot data. You have to now look forward. You have to look at forecasts again, when we were discarding forecasts for a long time. And, you know, bank earnings, and not just the big bank earnings, of course, a lot of the small banks are much more in focus, are probably going to be more informative than CPI data, which in many respects is backward looking at this point.
Ibrahim, I look at the debate right now. John and I were thunderstruck yesterday at some of the interviews, the intensity of belief in a slowdown a la what the IMF is programming for 5 years. You have a weak dollar case. Do you need a 5-year plan to get to a weak dollar as you and Kristalina Georgieva see it, or does it happen sooner?
No, we actually think of dollar weakness as a near-term window. It's that...
Well, Friday or, you know, September?
It's been going on since the beginning of the year, and for now we think of it for maybe the majority of the rest of the year, or maybe at least into the end of Q3. You know, we have these debt ceiling issues that we think won't be helpful to the dollar as well. But we think that there is a final hurrah waiting when the rest of the world catches up with that U.S. slowdown. A global recession in 2024 should still be the base case. I actually think that will come back to be somewhat dollar supportive. So for now, it's a dollar-centric weakness window for the next 1 or 2 quarters from now.
What's fascinating to me, summing up 2 days here, is the idea that Goolsbee, with that important speech of Chicago, and Michael Daugherty yesterday channeling an ancient Chicago school, which really looks for a slowdown of real economy and slowdown of inflation together. That seems to go against Hollenhorst and Clark. What does the dollar do? Daugherty says the Fed has gone too far. He says they've lost the plot. If they have to confront lower nominal GDP, that's got to be yen 110, yen 95, euro 130. Can we think of those magnitudes if we get that level of Fed failure?
We think eventually, yes. So when it comes to when we get to and through the recession and maybe to the multi-year dollar, the multi-year part of the dollar down cycle, then we think, you know, the euro dollar above 120, dollar yen below 110 are certainly very close.
Come on, we got to make news here on a Wednesday morning. Can we get yen below 100?
I think we will still see it in the course of the next few years, but we have plenty of gyrations between now and then. And you mentioned nominal GDP growth. We think the Fed worries about inflation. When nominal GDP growth is weak, they'll have a whole host of other problems to contend with. So you have to be careful what you're wishing for at this point.
Ibrahim, this was great, as always. Ibrahim Rakbari there of Citi. Thank you, sir. Talking up the potential for a global recession in 2024, I think that was interesting. 2024, and then you shift to the other side of the dollar smile. And that's where the dollar support starts to come in, maybe, going into next year.
But until then, the bank stress and potential dovish, hawkish, dovish kind of surprise that you could get from the Fed could provide, as Ibrahim says, a buying opportunity before what we get in 2024.
A lot of people have booked European vacations, Tom, in the United States for this summer. I'm not sure they're hopeful about 120 euro dollar. 120?
Yeah,
130. You were talking 130.
We're egging them on. I mean, it's way too early in the morning for Ibrahim, but the bottom line is the scope and scale of 130 euro. John, you've lived it. That changes things in Europe, and frankly, I don't know. Do you extrapolate that out to a 128 sterling? I mean, that's.
I remember a time when
these are big moves.
130 was poison for the ECB because they wanted the euro weaker, and how things have changed. The story's changed in a big way.
Well, and again, I think we didn't discuss it here. We'll have to have Ibrahim back here, but one of the backstories that's IMF is the Bank of Japan's new leader in what's going to happen with yield curve control. That's a whole separate issue.
When it comes to the fact that the euro has been as weak as it has, have you seen the crowds at the different tourist centers in Europe? It's been unbelievable, these sort of record hordes of Americans. I wonder if people like it or if they don't. I bet it's a sort of a bittersweet.
You mean the locals?
The locals, yeah.
The locals? No, I think the locals in Europe love the American tourists. If you work in hospitality.
Of course.
Great tippers.
Great tippers.
Great tippers.
Europeans don't tip, do they?
Well, the Brits have a reputation for not tipping so much, but that's because we pay people well, so that we don't have to.
That was very defensive. You know? Glad to know.
It's a point of tension at the moment. We can build on that another time. Fantastic lineup of guests down here in Washington, D.C. Amy Wu Silverman of RBC Capital Markets is going to be joining us in the next hour. Equity futures on the S&P 500, just about positive.
Keeping you up to date with news from around the world with the first word,
I'm Lisa Mateo. Well, we have the Biden administration is proposing a tough crackdown for auto pollution. Right now, tailpipe emission limits are so strict that they will compel automakers to ensure 2 out of every 3 cars sold in 2032 are electric models. But still, there's questions whether car companies can fulfill the fleet-wide limits on carbon dioxide and smog-forming pollution. President Biden is in Belfast, Northern Ireland, where he'll mark the 25th anniversary of the Good Friday Agreement. Now, that deal ended decades of violence between Catholics and Protestants. The president's also meeting today with UK Prime Minister Rishi Sunak. Officials at the Fed are signaling there's a divide over raising interest rates again. New York Fed President John Williams says there's still more work to do to bring down inflation. Meanwhile, Chicago Fed President Austin Goolsbee became the first official to suggest that policymakers may need to hold off on further hikes for now. We get the latest numbers on consumer prices at 8:30 New York time. Donald Trump wants a 4-week delay in the start of a civil trial over his alleged rape of John Carroll. Now, his lawyer says a cooling-off period is necessary following his indictment of the case of hush money payments. The trial in the Carroll case is due to start April 25th. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Europe. Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in focus today on Bloomberg.
Given how much uncertainty abounds when these financial headwinds are going, I guess I think we need to be cautious. We should gather further data, and we should be extra careful about raising rates too aggressively until we see how much work the headwinds are doing for us in getting inflation down.
That was a brilliant speech by Austin Goolsbee, the Chicago Fed president, delivered yesterday, pleading for patience, prudence, and we can talk about it all a little bit later. I'm happy to say that Lisa's back in the building. Good to have her back. Lisa Abramowitz, Tom Keene, Jonathan Ferro. This is Bloomberg Surveillance, and here's a taste, a flavour of the price action going into the opening bell in a few hours' time. Before we get to that opening bell, US CPI just around the corner, about 2 hours and 12 minutes away. Equity futures going into that positive 0.2% on the S&P 500. Tom, yields just a little bit higher here on a 10-year, 345, yields higher by 2 basis points. Euro showing a bit of strength, dollar some weakness. The euro against the dollar, euro-dollar 109.30. We're positive there about 0.2%.
The main trend here, John, not mentioned, is a Bloomberg Financial Conditions Index with an absolute total complete vengeance has moved from restrictive to a more accommodative stance. It's not above the zero mark. It's a standard deviation measurement, but we've gone from a negative 1.2x up sharply in 17 days to a negative 0.14. I think it's underplayed, and this goes to the dynamics of the moment based on the data. It'll be interesting as one example how that plays off the inflation statistic at 8:30.
I think for much of the last 12 months, we've gauged financial conditions based on what equities are doing, what the dollar's doing, where credit spreads are. Increasingly over the last month, Lisa, we've seen a shift. The focus now is going to be on lending standards, the Senior Loan Opinion Officer Survey that I believe we get in early May. That's going to be a big focal point for a lot of people to gauge where financial conditions are going.
The problem is it's completely ambiguous and there's no actual metric for it. So it's a guessing game. And how do you have a guessing game at a time where the rest of the economy is also a guessing game, on top of a guessing game, on top of an assumption of where we're heading, which everyone agrees to disagree upon, where IMF is basically saying we're going back to where we came from. And many other people, I would argue most other people, think we're going to enter a higher inflationary regime post-pandemic.
When they say data dependence, it always sounds objective, doesn't it? It sounds really objective. We're about the data dependence. We're dependent on the data. It's highly subjective. You get to choose which data matters more to you, what weight you put on, say, CPI, on GDP, on payrolls, and how much weight you put on the Senior Loan Opinion Officer Survey that we're going to get a little bit later.
It's data dependency whack-a-mole. I mean, honestly, at what point do you end up just basically looking around for what confirms the story that you want to tell? Because how do you put, for example, what we get from JP Morgan on Friday into the data bucket? Because that's where it's going with respect to how much they're going to be looking to what we're seeing going forward with lending standards.
Or I should say Senior Loan Officer Opinion Survey.
May 8th.
Thank you. Thank you for that. May 8th. And I believe Chairman Powell will actually have some understanding of what that looks like when he meets with his committee on May 2nd, May 3rd.
Yeah, I don't know with the banking data, but frankly, this morning's data point is, I'm going to suggest, the most important data point to May 3rd. And I mean, it could be right on plan and boring, a snooze, and, snooze fest and off we go, but we just don't know.
Priya Misra of TD thinks that for the market at least, bank earnings and this kind of lending data, more important than CPI.
Yeah.
More important than CPI.
Yeah, and again, deposit flows, and again, I looked at the BTMM screen today, the classic money market screen of the Bloomberg, and John, I look at 3-month LIBOR, and that's all you got to look at. You don't have to look at anything else. Money market funds reign supreme.
Well, it speaks to the deposit flight.
Yeah, and continued, and even if it's a slower level than 2 banks going under in California on bad marketing plans, the answer is you're going to have a continued flow. Speaking of flows and looking at flows of goods and of trade led by sanctions is Daniel Tannenbaum. He's global anti-financial crime practice leader at Oliver Wyman, I should say, senior fellow at the Atlantic Council, and far more importantly, Dan Tannenbaum is down here. As a kid, he played Risk, like he'd be 3-on-2 Central America, and we played through the dull summer months, the game of Risk. You're doing it in reality here with scenario analysis. What scenarios are you looking at in Washington?
Realistically, there's a few things going on in the world. I mean, if you would have told me 2 years ago that Russia would be sending its aircraft to Iran for routine maintenance, I would have said you were crazy. You're now seeing China broker peace deals between Iran and Saudi. I mean, the whole geopolitical landscape continues to shift, but for a lot of my clients, especially off the back of the last year, with Russia really beginning to look at some of the China-U.S., China-Western tensions to see, what do we need to be prepared for in the event that things get worse? Now, China is a much more rational actor than Russia by a country mile, but I think folks got burned on Russia lost significantly. Now you have assets being nationalized or threatened to being nationalized. No one wants to be caught flat-footed, so people are really trying to look at the what-if scenario right now to see how can we prepare accordingly.
Earlier this week, Peter Cheer is on the show with Tom and John, and he said that this is a more perilous time geopolitically than we've seen in a very long time. His crew of military leaders, former military leaders, assessing this. Given that, how are some of these companies preparing for that? The steps that they're taking amid all the other risks with inflation and growth concerns?
I think they're really looking at the unintended consequences now, kind of if this, then that. So let's say you sanction, there's heavier sanctions on a commodities sector, for instance. Technology companies that purchase certain precious metals to use downstream in their supply chain, there's a cost to that. There's a cost to consumer. When you look at country-related sanctions where there's significance, you're really trying to look at how to safeguard your IP, how to safeguard your human capital. There are no good answers to this. There's really just a whole bunch of scenarios and playbooks to really look to try and iron out what could happen, what can we do. But there's no good answers. That's really the challenge.
Are your clients worried about stranded assets in Taiwan or China or both?
My clients are worried about stranded assets in any country where there's broader geopolitical risk, some having had stranded assets in Russia, some that are on the verge of being nationalized. So I think at this point, they're really looking everywhere, but it's not just those countries. If you look at the other countries that are known to be supporting Russia, for instance, the UAE has a ton of pressure on it for all of the influx of Russian capital. That could also backfire on businesses operating in that region if the U.S. and its allies tend to focus more harsher enforcement and sanctions on those that are harboring Russian assets that they may not want there.
Well, key phrase there, the U.S. and its allies. Where are the allies of the United States on some of these issues now? And are you convinced that if they tried to impose sanctions on a place like China in the way they have done with Russia, that those allies would be on board?
So China isn't Russia, and I think China has taken an extremely measured response to all of the issues, even thinking back to the Trump years and the bluff and bluster, as Tom would say, of some of the Trump rhetoric against China. China's responded very measured, and I think that business reacts to that and recognizes that you're dealing with a much more rational actor that sees the downside risk to their economy. And companies are aware of that, but they also want to take certain precautions to make sure they're not caught flat-footed.
Lisa, by allies, of course, I'm alluding to one person.
One person.
In particular.
It was quite
last
clear.
Week.
Emmanuel Macron. You're basically saying, is he going to come out and say, well, you know, we're a friend to China, so come do business with us? And I actually wonder if any businesses are actually reducing some of their assets in those nations, or if they're just making lip service.
There's so many conversations that we've had so far this week down in Washington, Dan, keep coming back to the comments from Emmanuel Macron.
Who? Sorry?
What did you make of that?
Look, I mean, I don't think those comments were on behalf of the bloc. I think those comments were definitely on behalf of France. And if that is the case, in reality, I think that's a far better outcome for geopolitics. If that was representative of the bloc's view, then that might be a slight problem for what's trying to happen on a broader Western campaign of alignment.
Just a bit. Dan Tannenbaum of Oliver Wyman. Dan, thank you. Those conversations keep coming around, Tom. I've said it a few times. Not for me to imply that he was doing this for self-interested reasons, but certainly we're not talking about the burning streets of Paris right now, are we? We're talking about...
That's next week.
Other things.
I think Tannenbaum, his scenario analysis for Elon Musk in Shanghai, now that's a document I'd like to see.
Oh, yeah. Big time. New facility in Shanghai. Lots of investment there in a big way.
Tannenbaum does. He does scenario analysis.
Should we do some of that scenario analysis next time?
Yeah.
Okay. Can we do Tesla specifically with you, Dan?
No.
No, didn't think so. Any features positive on the S&P from Washington. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Live from Washington, D.C., this is Bloomberg Surveillance. Here's a taste of the price action 2 hours out from the CPI report in the United States of America. Futures positive by 0.2%. Yesterday, a total snooze on the S&P 500.
Snooze first.
Totally unchanged. Bit of weakness in the NASDAQ, bit softer. Yesterday, this morning, positive 0.1%. Elsewhere in the bond market, 2s, 10s, 30s, shaping up as follows. Your 2-year going into this print. Yields higher by 3 basis points, reclaiming a 4 handle on a 2-year, 4.0539% on a 2-year yield. Just to round things out with foreign exchange, just a sneak peek of euro dollar for you. The euro stronger this morning against a weaker US dollar, 109.27, positive there by a little more than 0.1%. That's a price action. For a summary of the conversations on this program, I want to point out Lisa's latest work. Subscribe to the Bloomberg Surveillance newsletter. There we go. Bloomberg.com/surveillance.
What was that?
Subscribe at Bloomberg.com/surveillance.
What's the goal here, Lisa?
Basically, to understand the main themes of the day that we talk about. And also, we have so many amazing conversations with people to understand and distill the main debates that kind of come out, the sort of threads that sort of emerge every day. I personally think it would be helpful.
Can we rename it the Daily Gloom, the Daily Anxiety?
Yeah, we were going over the
Toxic Brew.
We were thinking about a branding.
I actually know that because I got a couple of votes for Toxic Brew.
Toxic Brew is pretty cool.
The morning Toxic Brew.
Toxic Brew is pretty cool.
I'm sorry. I think it pops.
Toxic Brew works.
Yeah, well, only if when you open it, you get burp, burp, burp every time you open it.
We should put that in too. Just some sound effects. Please subscribe. We'll talk about it through the show. Subscribe for Bramo. Okay, 2 hours away. Is that enough? That's enough.
That's
okay.
enough.
CPI coming up a little bit later this morning. Big banks out with their estimates already. Bank of America, Wells Fargo, Goldman, Morgan Stanley, all forecasting 0.4%. An increase of that in core inflation month over month. Meanwhile, JP Morgan and Citi expecting a move, Tom, of 0.5%. So JP Morgan Citi looking for 0.5.
Right.
Core month over month is this big focus for Wall Street and has been over the last several months.
Big change year over year is sort of, durable goods. You look at a 3-month moving average, everybody has a convention, and here it's year over year. And what, John, 6 months ago, the adults total's moved to month over month. I mean, that's
without a doubt. Just to picture the trend, just to get an idea of the trend.
So let's do that right now. Blarina Urichu is U.S. economist at T. Rowe Price. This is really important. Just did a great panel with her with Quinnipiac that was just wonderful. And I want to go to where we were there, which is really dive into the inflation data. So the zeitgeist is goods and services. The focus is on services. How does real estate distort the report at 8:30 this morning within the services vector of inflation?
That's a great question. We're talking about a third of the CPI basket, which comes from the rent and OER components. That's reflecting real estate, the tightness in the housing market in the U.S. We don't have enough rental units, so rent prices increased significantly post-pandemic. And then the quirk of the CPI is that the way the tightness in the housing market feeds into that index is very, very lagged. So we're dealing with quarters and quarters of high rent components in the CPI basket when the housing market itself is starting to cool.
I saw, I believe in the Telegraph today, a discussion of how Britain is now rolling over within a floating rate set of statistics to a new reality on inflation, a reset in mortgages. And it's like, we don't have that. If it's lagging, how lagging is lagging? How far out do you look to get the reset of the inflation we're living now?
So we have two different things going on here. First of all, the lags with the rent and OER components are about 6 to 12 months. So I'm looking at the middle of the year at the earliest where we might see some signs of easing in those components of CPI. And then in the UK, we have a floating mortgage market. Here, mortgages are fixed for 30 years. So the way they feed into the price components are also very different.
Are there reasons for the Fed to have a bias to look for an excuse to not hike more? Is there a reason in the data that perhaps isn't coming out in the headline figures that we're going to get today or even in the core, but underneath in the small components feeding it?
So when you look at the data right now, what we have to realize is that they are backward looking. All the information we're getting now are data before SVB and before the bank failures. Now going ahead, we're expecting some tightening in credit conditions, which will affect the economy and inflation with a lag. What we're seeing now, it's very strong, and it speaks to a different world than what we're living right now. And so for the Fed, I think this will be interesting because they're making a policy decision based on something that is not forward looking.
Is bank stress disinflationary? There was actually a really interesting report talking about how it's stagflationary, because if you reduce credit, then companies are forced to produce less and basically raise the prices. So isn't this essentially a recipe for stagflation, whatever way you cut it?
You are basically raising the cost of capital, the cost of doing business. There are theoretical models that make the same point, Lisa, that this can be inflationary. Now, and when you look at the history of data, the way credit crunches work on the economy, they have long lags. So this is not going to be short-term disinflationary for the Fed. I don't think so.
Does the Fed have the luxury of waiting? Does it have time on its side?
I don't think they do. I think they've made it very clear also that they need to at least get to what they promised us on the summary of economic projections. And they also need to stay there for some time. Time and again last year, Powell made the analogy that he does not want to be the Burns of this generation. He does not want to cut interest rates too soon.
He doesn't want to be Burns. We've raised the question.
I don't see him being George Burns in the press conference.
Whether he risks being Trichet and hiking into a crisis. Does he run that risk as well?
I think he does, and that's a risk that they are prepared to take based on their reaction function and their communication, that they would rather over-tighten than under-tighten and have to do more down the line.
Well, this is a key theme here in the last 48 hours. Right now, are they over-tightening? And if they go 25 on May 3rd, what level of over-tightening is that?
So we're all a little bit in the dark because we don't know what the equilibrium interest rate is in real time. But based on how the economy overall is behaving, and by that I mean the real economy, the labor market, it doesn't feel like the Fed has over-tightened. Based on what's happening in the financial sector and banking system, maybe rates are a bit too tight there. So we're going back to that discussion we had before with R-star and R-star-star. Maybe the financial stability interest rate, equilibrium interest rate, might be lower than the real economy equilibrium interest rate. And that's what we're finding out this quarter.
That's a raging debate right now. When you get 8 economists in a room, John, you're going to get 9, 10 responses to R-star, R-star.
Particularly now.
For those of you at home, there's R-star, star. That happens after 5 p.m. When I look at R-star, star, it's a bunch of theoretical mumbo jumbo. Our listeners, our viewers are living tangible inflation. When do they, besides a 12-month look back where they get solved, when do they feel better?
So that means when is inflation down in a meaningful way, but the labor market has not deteriorated dramatically. This is the fine line that the Fed is trying to walk, right? And there is no guarantee that this is going to happen. When you look at their summary of economic projections, they're telling us they expect the unemployment rate to increase by 1 percentage point. If inflation slows but the unemployment rate increases, that doesn't feel great. And then they're at the same time saying that this is not necessarily a recessionary outcome. But you look at the sum rule, which tells you historically, once the unemployment